Good morning and welcome. I'm Doug Apple, Chair of the New York City Rent Guidelines Board. I'd like to welcome you to this meeting of the board. This is the third meeting in a series of public meetings and hearings to determine lease adjustments for rent-stabilized housing units in New York City with leases commencing or being renewed on or after October 1, 2025 and on or before September 30th, 2026. I'll now take a roll call. Please respond if present. Hennessis Aquino. Alex Armlovich.
Present.
Robert Ehrlich.
Present.
Arpit Gupta. Not here yet. Reed Jordan.
Present.
Alex Schwartz.
Present.
Christina Smith. Not present. Adon Sautran.
Present.
Doug Apple. I'm present. Let the record show we have a quorum. The next planned meeting of the board will be here at Spector Hall on April 24th, starting at 9:30 a.m. The board will hear testimony from speakers who have been invited by the tenant and owner members of the board. Speakers representing tenants will be heard from 9:45 to 12:15, and speakers representing owners from 1 to 3:30. Our RGB tenant and owner members, please get a list of presenters to Andrew by April 22nd if you can. The public can also live stream this upcoming meeting via YouTube at youtube.com/rentguidelinesboard. The preliminary vote for rent-stabilized lease adjustments will be held April 30th. This in-person meeting will start at 7 p.m. and be held at the LaGuardia Performing Arts Center at LaGuardia Community College in Long Island City, Queens, where the vote was last year. If you plan to attend, please use the entrance on Van Dam Street at that intersection of 47th Avenue. Doors will open at 6 p.m. This meeting will also be live streamed via YouTube. Information regarding this meeting will be posted at our website, nyc.gov/RGB, in our meetings section. If you're interested in receiving email updates about upcoming RGB meetings and hearings, please go to our homepage and click on the quick links. Today, staff will present the 2025 Price Index of Operating Costs and the 2025 Mortgage Survey Report. A copy of these reports are in your meeting folder, along with the staff's presentation slides. There are copies of the reports here today, and they'll be made available on our website after the meeting. A copy of the report will be also posted on our website. Just click Research on our homepage to download these documents. After the staff presentations, we'll hear from the Community Preservation Corporation, HPD, the Department of Housing Preservation Development, the Columbia Center on Poverty and Social Policy, and the New York State Housing and Community Renewal Agency. Also in your folders, you'll find a memo from staff regarding data requests from the 2025 INA study. In addition, there's charted history of preliminary guidelines and the final guidelines dating back to 1989. After a friendly reminder that members, you all got to do your conflict of interest, don't forget by May 2nd. I will now introduce Andrew McLaughlin, RGB Executive Director, who will be presenting the 2025 Price Index of Operating Costs. And if anybody can't see, thank you, Danielle. Can always readjust.
There's also, again, the presentation in your folder, so if you're having trouble seeing it on the screen up top, just let you could use those slides.
Just while you start this, for the record, I want to that Arpit Gupta has now joined us. Well shorn and looking on the record.
Okay, good morning, everyone. I'm here today to present the 2025 Price Index of Operating Costs. And this particular index gathers prices for a market basket of goods and services used in the operation and maintenance of buildings that contain rent-stabilized units in New York City, and uses these prices to estimate cost and price changes from one year to the next. Separate indices are calculated for rent-stabilized apartments, hotels, and lofts. In the PIOC, we identify prices for various items that are representative of the operating costs for apartment buildings in New York City. The importance of each of those items in calculating the PIOC is its weight. This should be based on how much owners has spent in the past for that category of expenses. And finally, the change in price or cost is referred to as a price relative. Before we go take a more in-depth look at all the different changes within the components, it's important to note that the data collected by the price index is gathered from 4 source types: government agencies, vendors and contractors, unions and utility companies, and owners of rent-stabilized buildings. Government agencies accounted for roughly 36% of the data that we use in this report. Vendors and contractors, 29% representative of the data. Unions and utility companies supply about 14% of the data. And unlike the data reported in the RGB income and expense study, which is 100% owner-reported data, only 21% of the data used for the price index is gathered from owners of rent-stabilized buildings. Here's an overview of the changes in the apartment price index, which we will go into detail shortly. Also shown here is the weight of each PIOC component. Notably, taxes, which account for nearly 29% of the price index, increased 3.9%. The largest proportional increase was seen in insurance, 18.7%, followed by utilities, which increased 8.2%, and fuel costs, which increased 10.3%. More moderate increases were seen in administrative costs of 5.1%, labor costs 3.7%, and maintenance 4.3%. These changes in costs resulted in an overall increase of 6.3%, and by comparison, the CPI increased 4% over this same period. Over the past 5 years, PIOC costs have increased by a cumulative 28.1%. Now I will outline the changes in the cost for the 7 components that make up the apartment index, starting with the tax component. The real estate tax component of the price index carries the most weight, representing about 29% of owners' costs. This slide outlines the impact that assessments, the tax rate, exemptions, and abatements have on the total tax rate change. As noted previously, this year taxes increased 3.9%, driven largely by a rise in assessments. While assessments rose 2.6% in fiscal 25, the increase in assessments was responsible for 3.5% rise in the tax component, a larger impact than the previous year when assessments were responsible for just 0.6% rise in the tax component. The large majority of the buildings that are contained rent-stabilized units are in tax class 2. Last year's average annual tax class 2 rate of 12.502 decreased by just 0.02 percentage points, resulting in a new annualized rate of 12.5 for this most current fiscal year. This minute decline follows 2 consecutive years of increase in the tax rate. In fiscal year 25, the change in the tax rate had no impact on the rise in the tax component, unlike the previous year when the tax rate was responsible for 2% rise in the component. The decrease in the value of exemptions resulted in a 0.2% increase in the tax component, and a decrease in the value of abatements also caused a 0.2% increase in the tax component. As you can see on this graph, you can disaggregate the tax into several components. The black line on the chart represents the change in taxes from one year to the next. This year, the change was 3.9%. The change can be broken down into the impact in assessments, which is the orange bar, and the impact in exemptions, which is impact of exemptions, abatements, and changes in the tax rate, which are grouped together in the maroon bar. The change in taxes, as you can see, was primarily due to a rise in assessments of 2.6%, which was responsible for a 3.5% increase in the tax relative. It is interesting to note that since 2007, the increase in the real estate taxes have more often than not been driven by change in assessments. The next component is the labor costs, which rose 3.7%. The price index measure of labor costs includes union and non-union salaries and benefits, in addition to Social Security and unemployment insurance. The cost of non-union labor makes up 58% of the labor cost component. The entire labor cost component comprises 12% of the overall PIOC. Wages comprise nearly 80% of this component. Non-union pay increased 4%, while unionized wages also rose, rising by a combined 2.9%. Health and welfare benefits, which comprises 14% of the labor cost component, increased 2.9%. An increase in unemployment insurance of 11% had minimal impact since it accounts for only 1% of this component's weight. Our next component is fuel. The fuel component comprises 8.1% of this year's price index. The change in cost measured in this component considers both the change in weather and the change in prices for heating multifamily buildings with fuel oil, natural gas, and steam. This year, the fuel component increased 10.3%. Natural gas costs, which account for 68% of the overall costs in the component, increased by 9.6%. The cost for heating buildings by fuel oil makes up 32% of this component and increased by 11.7%. And steam costs increased the most, 19%, but these costs account for less than 0.5% of the fuel component's weight. The utilities component consists of costs by owners for non-heating natural gas and electricity costs, as well as water and sewer charges, and it comprises 10.6% of this year's price index. This year, utilities increased 8.2%. The growth in the component was driven by an 8.5% increase in the water and sewer rate. This item accounts for just under 2/3 of the utilities component. Non-heating electricity costs, which account for nearly 1/3 of the weight in this component, increased 7.6%, while non-heating gas costs, which account for less than 2% of the utilities component, increased 7.9%. We'll now move on to the maintenance component, which includes services performed by contractors, such as painters and plumbers, and hardware and cleaning items, and appliances that need periodic replacement. The component accounts for 18.4% of this year's price index. This year, maintenance increased 4.3%. Of the 29 expense items contained in this component, just 4 items account for half of its expenditure weight: repainting, plumbing faucet, plumbing stoppage, and electrician services. This year, painters' rates rose 5.8%, combined plumbing rates increased 1.6%, and electrician services rose 5.2%. Other price index increases of note were boiler repair, which was up 1.4%, floor maintenance 2.2%, roof repair 9.6%, which represent a total of 6 expense items and accounts for 21% of this component. Next up is administrative cost component, which rose 5.1% and comprises 13.4% of the price index. Fees paid to management companies, accountants, and attorneys make up 87% of the administrative cost component. Much of the increase in the administrative costs can be attributed to the rise in attorney fees of 6.7%, and accounting fees, which increased this year as PIOC by 3.8%. These 2 items account for 44% of the administrative cost component. Communications, which accounts for 4% of the administrative costs, increased by 1%. Management fees increased for the second consecutive year, rising 5.1%. These fees comprise 43% of this component. The largest increase in this year's PIOC was in the insurance cost component, rising by 18.7% compared to last year's increase of 21.7%. Insurance costs account for 8.6% of the price index. On average, larger policies in this year's PIOC increased by a lesser proportion than smaller policies. Policies that cost more than $10,720, which represent half of all the insurance quotes, saw an increase in costs of 18.4%. Upon renewal, however, buildings and policies that cost $10,720 or less saw an increase of 20.7%. New this year, staff calculated the change in insurance costs by the age of the building. Insurance costs rose more in pre-1974 buildings, rising 20.7%, than in the post-1973 buildings, where insurance rose 9.1%. We'll now move on to the other indices that are calculated in this report for apartments based on building type. In addition to the price index for all buildings that contain rent-stabilized apartments, the PIOC includes separate indices for gas-heated and oil-heated buildings. This year, the gas-heated index rose 6.2%, less than the 6.6% rise in the oil-heated index. Not only does this report include indices based on the type of heat used in a building, but indices based on building age are also calculated. On whether a building was built before 1974, pre-1974, and for buildings constructed in 1974 or later, which we refer to as post-1973 buildings. This year, the pre-1974 index rose by 6.4%, slightly less than that of the post-1973 index of 6.5%. The primary difference between these two indices is the disparity in the taxes and insurance cost components for each index. Taxes rose in the pre-1974 index by 3.1%, compared to 10% rise in the post-73 index. In contrast, insurance costs rose more in the pre-74 index, 20.7%, than in the post-1973 index of 9.1%. The core PIOC rose 6% in 2025. This index measures long-term trends by factoring out shifts in fuel costs for heating buildings that contain rent-stabilized apartments in New York City. The rise in the 2025 core PIOC was 0.3 percentage points lower than this year's apartment index, which was 6.3%. This year's core PIOC rose at a slower pace than the overall PIOC because fuel costs, which were not used to calculate the core, increased 10.3%. Section 26.510 of the Rent Stabilization Law requires the board to consider prevailing and projected operating and maintenance costs for buildings containing rent-stabilized apartments. Projections for components of the price index are calculated to provide the RGB an estimate of how much costs are expected to rise in the year following the current price index. The table on this slide shows projected changes in the PIOC components for 2026. Overall, the PIOC expected to grow by 4.8% from 2025 to 2026. Costs are predicted to rise in each component except fuel, with the largest growth, 17.7%, projected to be in insurance costs. Taxes, the component that carries the most weight in the index, is projected to increase by 3.2%, while fuel is projected to decrease by 4.4%. Other projected increases include maintenance of 5.7%, utilities 5%, administrative costs 4.3%, and labor costs 4.1%. The core PIOC is projected to rise 5.6%, 0.8 percentage points higher than the overall PIOC projection. In addition to the apartment indices, the 2025 price index report also includes indices for hotels and lofts. The price index for all hotels increased 7.3% this year. There were increases in all of the 7 hotel PIOC components. The insurance cost component had the highest proportional increase, rising by 18.7%, but accounts for just 8.5% in the index. Fuel rose by 10.1%, and utilities by 8.2%. More moderate increases were seen in administrative costs, 7.1% increase, taxes 6%, maintenance 3.9%, and labor costs 3.7%. The hotel price index includes separate indices for each of the categories of hotels that contain rent-stabilized units due to their dissimilar operating cost profiles, and a general index for all hotels, which we just looked at. Among the different categories of hotel, the index for traditional hotels increased by 7.5%, rooming houses by 7.7%, and SROs by 7.1%. The increase in the loft PIOC this year was 9.6%, higher than the increase of 8.6% in 2024. Increases in costs were seen in the 8 components that make up this index. Insurance costs saw the highest increase, rising 18.7%, followed by rises in the fuel of 12.5% and utilities of 8%. Remaining 5 components all rose by lesser proportions, including administrative costs legal up 6.7%, administrative costs other 5%, maintenance 4.4%, taxes 3.9%, and labor costs rose 3.6%. Note that historically administrative costs in the loft index has been split into 2 components, administrative costs legal and administrative costs other. Therefore, there's 8 components in this index. So the commensurate adjustments, which are a series of formulas which combine various data concerning operating costs, revenues, and inflation into a single measure that determines how much rents would have to change for the net operating income, or NOI, or the amount of income remaining after operating and maintenance expenses and debt are paid, of rent-stabilized apartments to remain constant. The commensurate formulas provide a set of illustrative adjustments for 1- and 2-year leases that would hypothetically compensate owners for the change in prices measured by the PIOC, in addition to other relevant metrics, while keeping NOI constant. For example, if NOI was $400 and the income was $1,000, how much would rents have to change to keep the NOI at $400 in absolute fixed dollars? In its simplest form, a commensurate rent adjustment is the amount of rent change needed to maintain NOI for rent-stabilized apartments at a constant level from year to year. In other words, the commensurate provides a set of illustrative 1- and 2-year renewal lease adjustments or guidelines. Note that the commensurate adjustments presented on the next slide do not constitute staff or board recommendations for guideline adjustments. The various data points presented in the 2025 PIOC and other rent guidelines report and annual research reports, such as the Income and Affordability Study and the Income and Event Study, supplementary data sources, in addition to public testimony, can all be considered to determine appropriate rent adjustments. The first commensurate method is called the net revenue approach, designed to consider the change in the price index and revenue received by owners based on an estimate of tenants who signed either 1- or 2-year leases. Under the net revenue formula, a guideline that would preserve NOI in the face of this 6.3% increase in the price index is 4.5% for a 1-year lease and 7.75% for a 2-year lease. The second commensurate method, the CPI-adjusted NOI formula, considers the change in the price index, the mix of lease terms, and the effect of inflation on NOI. A guideline that would preserve NOI in the face of the 4% increase in the CPI and the 6.3% increase in the price index is 6.25% for a 1-year lease and 9.75% for a 2-year lease. The third commensurate method, the traditional commensurate adjustment, is the formula that has been in use since the inception of the Rent Guidelines Board, and is the only method that relies on both the current price index change as well as the PIOC projection for the following year. Note that this commensurate does not account for the mix of lease terms or the effect of inflation on NOI. The traditional commensurate yields 4.1% for a one-year lease and 5.8% for a two-year lease. This reflects the increase in operating costs of 6.3% in the price index and the projection of 4.8% for next year. So to sum up, the price index was 6.3%. It outpaced the CPI, which rose 4% during the same time period. Overall costs in natural gas heated buildings increased 6.2%, while overall costs in fuel oil heated buildings increased 6.6%. The PIOC for pre-74 buildings rose 6.4%, and post-73 buildings slightly higher, rising 6.5%. The core PIOC rose by 6%, and the PIOC for buildings that contain rent-stabilized apartments is projected to increase 4.8% next year. And I will now take any questions.
Any questions among the members? Adon?
Thank you, Andrew. I have two comments and then some questions. First, I just want to clarify that, well, Andrew, you're correct about Section 26510 of the Rent Stabilization Law. We are required to consider current and projected costs. It doesn't necessarily mean that we need to use the PIOC. So I just want to reiterate that while I appreciate all the work that the staff does to put this presentation and this report together, it doesn't necessarily mean that we have to use this, nor do we have to use this or give it as much gravity as it appears to, right? Because we're dedicating a large portion of a full day to this. So something to consider. The second thing I would just note is that while I appreciate your disclaimer about the commensurate rent adjustments, this often winds up leading to a misunderstanding by public, by the media, about what the appropriate rent adjustment should be. I think also the problem with the commensurates is that, as we talked about before, this assumption that we're trying to keep NOI constant at the appropriate level. I think we can all, or not all, some of us can debate what's an appropriate level of NOI. So I would urge my fellow board members, especially my newer folks, to consider the fact that these can appear misleading, and also, I think we should take all of this with a large grain of salt. So my question, first I have a question about taxes. So I realize that the taxes in the report are the largest, make up the largest component. Do we have information, historical information, about the offset that J51 abatements wind up, like the offset that would occur based off of those abatements and exemptions?
Well, when we come up with the overall change in tax, it's including those abatements and exemptions. I mean, most of the abatements and exemptions that are seen in the Class 2 multifamily universe that contains stabilized units would be seen in the 421 or the J51s.
Okay.
So it's captured in that number.
It's couched in the number? Okay.
Yes, yeah.
All right. That's helpful. And I'm hoping, I mean, HPD will be here later, and I'm hoping they can speak to the fact that J51R is hopefully going to have an effect on some of the tax numbers. Not in this, but more related to, I guess, the income and expenses that we'd like to see moving forward. The other question that I had was about the labor costs. Do we have data about whether or not there's union or non-union labor used in rent stabilized? Is it broken out by rent stabilized, or can we get that information?
Right. So what we do is the weights basically determine that. So what we're saying is about half, more than half, about 58% of the whole labor component is non-union labor. So that's saying that most stabilized buildings are using non-union labor. The other part of it is based on union wages and health and welfare benefits, which are generally given to those that are in the union. So the weights will determine that, and we periodically go back and check those weights to make sure that we're doing that. And I don't know, the last year we did the labor cost components, probably maybe 4 years ago, or maybe sooner. I don't remember. Years blend. But we do have a schedule to periodically check to make sure that we're representing in that labor cost the correct amount of union labor costs versus non-union labor costs.
Other questions, Alex?
Thanks, Andrew. I have a few questions. One is, I noticed that the New York metro area's CPI for the same period increased by, I think, by 3.8%. And I'm just curious, has the PIOC always surpassed the CPI in terms of its increase compared to overall inflation?
It depends on the time period that you're looking at. In recent years, it certainly has. In some years, it's less, but more often than not, the price index will exceed the CPI.
Okay.
I can circulate some information over the last, from the inception, and look at the CPI versus the price index. I can do that.
And another question is, so for the projection, do you know what last year's projection was compared to the actual?
Yeah, sure. So if you look at your report, I think it's page 11. No, not page 11. Page 10. So last year we predicted or projected that costs would go up 4.4%. In fact, they went up 6.3%, a 1.9 percentage point difference. Page 10, under the last paragraph on the second column there. So the biggest difference was in fuel costs. We projected that they would go down. They actually went up. That's the one that always gives us trouble. The one that probably gave us more trouble than normal is the water sewer rate went up after we did the report. It had been averaging about 4%, and it went up to 8.5%, which made the utility component off quite a bit. I think it was off. It was let me see here. So we predicted they were going to go up 2.4, but they rose 8.2. So that was a big one where we screwed up. And the insurance costs were, 3.6 percentage points higher. So that all contributed. The rest were pretty close. But the ones that are normally difficult for us to do is the fuel and the insurance in recent years. But added to that this year was the utilities. And we'll try to see, I think this year staff will take a look at what the water board decides and get that information to you. And if it changes the projection dramatically, we'll get that information to you. So right now we're projecting that the total utilities will go up 5%, but the water and sewer is nearly 2/3 of that, so that's what screwed us up there. But I'd like to point out last year we were 0.2 of a percentage point off. So some years we're on, some years we're not, but depending on what happens.
Yeah. And so lately, I take it, but the projections, do they take at all any consideration of the uncertainty regarding tariffs?
No,
Okay.
I don't think, yeah.
Yeah. Okay.
That'll be next year's challenge for us
I think
all.
we'd have to do an analysis every day to try
there's a lot
to
of
try to figure that out.
Yeah,
These-
that's-
These year's projections. And one last question. So regarding the commensurates, my take is that implicitly this is assuming a 100% stabilized building for the NOI. If it's a mixed building with market rate units, presumably, you could increase the rents more in the market rate units and not increase as much with the stabilized unit. So, I mean, I think that's the case, but.
We like to think of it as a unit,
Okay,
to keep the NOI for that unit. So if the unit is stabilized, that's what it needs to do. So if you have a building that has, half market, we're saying to keep the NOI constant in those half the units that are stabilized, those were the increases on those, that group, to keep that. So that's, I think, a better way to think of it, rather than the whole building. It's like we're trying to maintain the NOI for the commensurates are trying to do that for the unit. Which, if it's 100% rent stabilized, then
yeah,
it would, the commensurates, if you want to follow that reasoning, then that would be for essentially the NOI on the whole building.
right. Okay, thank you.
Yeah, please.
So, basic question that may be obvious to other board members. What is the value of the PIOC compared to the income and expense study?
Sure.
Like, what is it offering us that we aren't getting in another study?
So it's two different measurements. One is a price index, measuring prices, and there's some costs in our index. While the other measures what owners actually spent. So it's two different measurements. I guess trying to relate it to a CPI, if CPI goes up and high inflation and people tend to spend less, the amount they're actually spending is impacted by that. So an index, the price index would say, well, if you want to maintain the NOI, then this is what owners, because of what we measured as price increases, if they're spending the same on maintenance, or the maintenance they should be spending on, then the index will measure that. So very often in times of recession or during the pandemic, our price index was very different than the I&E, because owners changed their spending patterns where they could. But if it's more of a normal economy, then they tend to be close in lockstep. So those are the two main differences, and how the board wants to use one number to the other number, that's, your that's part of your decision, I guess, but they're measuring two different things.
Yeah, thank you, Andrew.
Hey, Norbert.
I wanted to follow up on the insurance component, which I feel like for the last several years has always been a big increase, and you're also projecting for next year it's also an increase. So, and I know we've talked about this before, but what do you think are the main drivers of this? Why is it that insurance rates are going up so much? Why are they going up more for the pre-74 stock? Again, I know it's not the largest component of cost, but it's experiencing such a large percentage increase year on year that I'm curious why that's happening.
Yeah, I mean, the thing we do with our insurance quotes, we do get them from owners, but we go to the insurance company to actually, for 85% of the costs, we actually call them and confirm. So we get some feedback on what's going on in that particular market. I think the pre-74, your instinct would say they shouldn't go up as much because the value of the building may be less than 73, but I think it's the risk that they feel. So they feel like the insurance has to be more on those buildings. So that's possibly some of what's going on. The rise in post-73, those tend to be insurance policies that are much higher to begin with. So even though they went up 9% versus 20% for the pre-74, doesn't mean that the policies are more. It's just that the increase was, proportional increase was less. But I think it's just all based on risk. I think there's other factors outside New York that is impacting insurance. Certainly, I think we see that. There's some other theories out there that I don't have data for, but the idea, particularly in the affordable housing group, their insurance rates are are really surpassed the free market group or the regular stabilized, privately owned stabilized group. So that's, I'm not giving you precise answers, but it seems like it's the perceived risk by the insurance company of insuring that building.
Just a quick follow-up. The risk of what specifically? Of issues with the building?
Well, I think part of it is-
Liability, of like climate, like what's like the specific risk?
Yeah, I think part of it is claims. In New York City, claims are very, very high when they're paid out. There's certain, so I think that's part of the fear. I think it's also other parts of the market outside of New York City that are impacting it. So they put that on top of there as well. I could try to dig in a little bit more information on that, but I'm not giving you a great answer. But it's all based on what they perceive as their risk of insuring that building. I will say there is movement out there for owners to try to insure their own buildings now, and so maybe that will help alleviate some of the costs that we see next year if more owners become a part of that. And I think maybe Doug can speak a little bit more to that, but so hopefully that will gain some momentum.
Yeah, just from my day job in affordable housing, I think the biggest change is the change in the marketplace, that there's less companies in the business in New York City writing policies. So now you have a different, and then the second biggest, I think, as Andrew's saying, is this is not unique to New York City. I mean, I actually haven't seen any studies nationally, but I've certainly heard anecdotally pretty significantly that across the country, liability insurance rates are going up significantly, driven by the large casualties in LA and Florida and Texas, right? I think the marketplace has changed. I mean, you'll see it almost across all the sectors of insurance coverage. And you're right, it's become one of the biggest drivers of cost, though it's still a relatively small proportion.
Yeah, although now it used to be the lowest component weight. It's no longer.
So it'd be interesting.
It's
actually,
It's higher than fuel costs now.
If you could like maybe do a chart, because I think the mix of weights actually is sort of an interesting thing to saying what's driving cost increases. Maybe you could do a chart, I don't know, I always like 10 years or 15 years, like what the weights look like in various categories. It might be hard to do but the bigger ones, because I think I'd be curious to see how much, because the problem becomes if your costs are going up in one component, you might have to be doing reductions in other components.
Correct, and that's how
So I'd be curious to see how the
part of
weights-
how our weights are adjusted every year. So
that-
depending on what happened
So
the
that'll
previous
tell you a
year.
little bit, so maybe looking at that chart.
Right. So so the 6.3, I can tell you now, the 6.3%, everything that's above that will get more weight in the next
Sure,
price index.
sure,
So
makes sense.
insurance obviously is going to even increase more. We may be topping like 9% of the component. Overall cost will be insurance next year. I would not be surprised if it's 9.5%. But
Right, but looking at that over time might be helpful.
Okay.
Thank you.
and for all, I'm assuming for all the components, like
Yeah, I think the couple will be
Sure, we could do that.
most important, but Rob?
Hi, Andrew.
Hello.
Two questions. The tax costs in the PIOC, are they inclusive of J51s?
Yeah.
They are. So that would, I mean, doesn't that skew the numbers a little bit?
Well, it does. Excuse not the right. It affects the numbers, but it's abatement and exemptions are not a very big part of that. It's driven by, particularly this year, it was driven by assessments. So the rise was almost 3.5 percentage points of the 3.9% rise was all due to assessments.
Right.
And then the exemption and abatement were the other 0.4%. I guess if you wanted to, take that out, maybe, you get to the 3.5%. I don't know. You really can't. I don't know if you can really do that, but it is the exemption and abatements are factored into that, and
Okay.
so.
And then, do you know what the commensurate adjustments need to be this year to return NOI to 2019 inflation-adjusted levels pre-1974, for pre-1974 buildings? I know, I'm making
Off the top of my head,
making you think.
no. Let me. I think we could probably do that, but
I mean, if you could, that would be great. I'm just.
good thing no one's filming this, so I don't have to be held to this. No, just kidding. So, all right. So you want to go back to 2019?
And
Yeah.
I certainly.
I mean,
I'm just curious.
The question, the context, if you're going to do that, Andrew, we should break it out into the typical components we do by geography, by pre-post 74. Because again, we have the sort of impact of the.
Yeah,
core
geography,
app.
we can't, that's not something we do with the price index.
Yeah.
The commensurates are not a
It's a
geography.
question that
Right.
Rob is asking.
Right, now,
To
the
extent
NOI,
break it out, I'd like
one of the formulas already accounts for inflation, so
Right.
I could just do that one, and that's only on the NOI. The inflation is the price index.
Right.
So that's been done, that's keeping up all the time. The NOI is what's impacted by inflation. So I'd have to think about doing that part of it in, I guess, $2024. I don't know, we'll have to take a look. I don't know.
I want to move along.
But
But take it offline. You can.
My instinct is to say that the price index is already doing that because think of it as the CPI, so we're adjusting each year that way.
Okay.
You're making me think, Rob.
Sorry.
I need another cup of coffee.
Sorry.
Sorry.
Other questions?
Just one last comment
Yeah.
on the commensurates. So last year's increase was a 2.75, which is within the commensurate range, and NOI went up 12%. I'm saying that's a pretty high number, considering.
Well, thank you. Thank you, Andrew, on the price index. And I guess next we're going to have Brian doing the mortgage survey report, which also includes sales data.
We're only 2 minutes behind schedule.
Great. Brian, you're going to make up 2 minutes. Talk fast.
You can blame me for that last question. Blame me for the last question. I'll take it.
Okay, good morning. I'll present the 25 mortgage survey report. What is the mortgage survey report? It highlights changes. I'm sorry. Let me adjust the font size here. Okay, since the 1980s, the Rent Guidelines Board has conducted a mortgage survey, which highlights changes in the New York City multifamily lending market over the prior year. The survey, which reports data solely for buildings containing rent-stabilized units, asks lenders questions about the financing, underwriting criteria, and other lending-related issues. In addition to the survey analysis, the report examines sales of buildings containing rent-stabilized units by volume and price. Before we go into detail, here is a summary of the highlights from the 2025 mortgage survey report. Among 100% stabilized buildings, the average per unit sales price citywide in 2024 was $175,225, an inflation-adjusted decline of 37.6%. Among all buildings with stabilized units, the citywide average price per unit sold in 2024 was $253,389, an inflation-adjusted decrease of 28.9% from the prior year. From 2019 to 2024, the last 5 years, among all stabilized buildings, the average inflation-adjusted per unit sales price citywide declined 47.0%. By borough, also from 2019 to 2024, the average inflation-adjusted sales prices declined 60.4% in Queens, 58.5% in the Bronx, 47.4% in Manhattan, and 37.1% in Brooklyn. A total of 550 buildings containing rent-stabilized units were sold citywide in 2024, a 6% decline from the prior year. And average interest rates for new multifamily mortgages decreased 28 basis points to 6.73% this year. First, we'll analyze the sale of buildings that contain rent-stabilized units. In 2024, 550 buildings containing stabilized units were sold in the city, a 6% decline from the prior year. Among buildings containing 6 to 10 residential units, sales volume in 2024 fell 8% from the prior year. Sales volume among 11 to 19 unit buildings fell 15%. Among 20 to 99 unit buildings, sales volume decreased 2%. And among the largest buildings, which contain 100 or more units, sales volume citywide rose from 11 buildings in 2023 to 19 buildings in 2024. Examining sales volume around the city, sales fell the most in Manhattan, down 23%, followed by Queens, down 12%, and the Bronx, down 11%. By contrast, building sales rose 26% in Brooklyn, and overall citywide sales volume fell 6%. And as in prior years, Staten Island was not included in this analysis because there are too few sales of buildings containing stabilized units to meaningfully measure change from year to year. Over a 22-year period during which we have collected building sales data, citywide sales reached their peak in 2005 with a total of 1,816 buildings sold. By contrast, sales reached their lowest point over this period in 2020 with 470 buildings sold. Sales volume subsequently experienced a 2-year growth period, but afterwards declined over the past 2 years. And next, we'll look at average sales price per residential unit in buildings containing stabilized units. In 2024, the average sales price per unit citywide was $253,389, an inflation-adjusted decrease of 28.9% from the prior year. Around the city, average sales price per unit was highest in Manhattan at $351,579, down an inflation-adjusted 30.1%, followed by Brooklyn at $253,160, down 6%, Queens at $157,188, down 16.1%, and the Bronx at $112,023, down an inflation-adjusted 48.1%. This graph presents the average sales price per residential unit citywide and by borough for all buildings containing rent-stabilized units since 2003 after adjusting for inflation. In 2024, although the citywide average sales price of $253,389 decreased from the preceding year, it is still high 81% higher than the inflation-adjusted price of $140,315 in 2003, the first year of this graph. Details for each year since 2004 are available in Appendix 10 of the report, which also provides a breakdown by borough. Considering building sales based on whether they were constructed before 1974 or after 1973, 34 buildings, or 6.2%, buildings sold were built after 1973. Units in these buildings sold for an average of $400,330 in 2024, an inflation-adjusted 38% decline from the prior year. The remaining 516 buildings were built before 1974, and units of these buildings sold for an average price of $234,481, down an inflation-adjusted 22.6% from prior year. Looking at the change in average sales price per unit based on the proportion of stabilized units in a building, among buildings with at least 50% stabilized units, the average sales price per unit was $187,307, a 24.9% inflation-adjusted decline from the prior year. Among 80% or more stabilized buildings, the average price per unit was $179,526, an inflation-adjusted 27.3% decline. And among 100% stabilized buildings, the average price per unit was $175,225, an inflation-adjusted decline of 37.6%. Next, we'll take a look at the mortgage survey. Each winter, the RGB surveys institutions that offer loans for multiple dwelling buildings in the city that contain rent-stabilized units. The survey is updated each year to include institutions that offer new and refinance mortgages. 7 lenders completed the survey this year, 1 fewer than last year. After 3 interest rate reductions by the Federal Reserve over the past year, the average interest rate for new multifamily mortgages was 6.73%, 28 basis points or 4% lower than a year earlier. This was the first decline in interest rates in 4 years. However, the moving 5-year average interest rate was 5.48%, up from 4.94%. The slide shows average interest rates charged for new mortgages since the early 1980s. Interest rates were in the double digits throughout the 80s and early 90s, but fell to a record low 4 years ago. After rising over the previous 3 years, interest rates declined again this year to 6.73%. Some lenders charge a separate upfront fee called points as a direct cost to borrowers. The average service fee charged on newly originated loans by lenders has decreased to 0.30 points, a reduction from the previous year's 0.37 points. Among survey respondents, points ranged from 0 to 1.13, with 4 surveyed lenders charging no points on new loans. This graph shows the average points charged for new mortgages since 1981. Average points reported in the survey have remained around or below 1 point for over 25 years, and this year the average points charged was 0.30. The average volume of new mortgage originations in our survey of buildings with stabilized units decreased from the previous year, from 31 last year to 19 this year. The average number of refinance loans also decreased from 20 last year to 11 this year. Among surveyed institutions, the typical maximum loan-to-value ratio, which is the maximum amount respondents were willing to lend based on a building's value, ranged from 60 to 85%. This year's average, 72.5%, increased 0.7 percentage points from last year's 71.8%. Another important lending criterion is the debt service coverage ratio, DSCR, which is net operating income divided by the debt service, reflecting an owner's ability to cover mortgage payments using its NOI. The higher the DSCR, the less money a lender is willing to loan given constant net income. The average minimum DSCR of 1.27 was minimally changed from last year's average of 1.26. Overall, DSCR at all institutions ranged between 1.15 and 1.50. This graph illustrates lenders' standards for maximum loan-to-value ratios since 1996. After 3 previous years of decline, the LTV ratio grew from 71.8% last year to 72.5% this year. The number of lenders reporting that they had non-performing loans among their portfolio of buildings with stabilized units fell from 6 lenders last year to 3 this year. However, those 3 lenders on average reported that approximately 4% of their portfolios were non-performing, an increase from 1.2% last year. Furthermore, 1 lender reported foreclosures this year compared to 3 last year. The lender reporting foreclosures indicated that they represented 2.85% of their portfolio. The average size of buildings varied widely among lenders. 2 lenders report a typical building in their portfolio contains 20 to 49 units. Another 2 lenders report 100 or more units. 1 lender reports buildings with fewer than 11 units. Another lender reports 11 to 19 units. And a final lender reports a typical building in their portfolio has 50 to 99 units. This graph shows average vacancy and collection losses since 1996. The average vacancy and collection losses declined slightly, falling from 3.31 last year to 3.14% this year, and the most recent year is at the top. Next, we'll discuss the longitudinal analysis, which examines findings among institutions that responded to our survey both last year and this year. Among the 7 respondents that completed the survey this year, all also responded last year. Like the main survey analysis, the longitudinal group saw interest rates decline. As of March 2025, interest rates were reported as 6.73%, down from 6.88% a year earlier. Among the longitudinal group, average points offered by lenders also fell from 0.45 to 0.30 this year. The average maximum loan-to-value ratio rose among the longitudinal group from 71.4% last year to 72.5% this year. The average debt service ratio also rose slightly, up from 1.26 last year to 1.27 this year. And similar to the main mortgage survey analysis, vacancy and collection losses among the longitudinal group fell from 3.71% last year to 3.14% this year. Thank you. I will now take any questions you may have.
Thank you, Brian, for the report. So I guess the number that stands out most to me is this dramatic decline in sales prices that we kind of see across boroughs. And it seems like a little different from the numbers that we saw with the NOIs. So if the NOIs are increasing on average, why then, does it seem like the sale price of these buildings are, collapsing so much? Does that suggest that we're not estimating the NOI correctly, or is that fallout of the broader financial turmoil, difficulties in getting lending from Signature Bank and so forth? Do you have any sense of what's kind of driving the price decline?
Regarding the NOI, the NOI reported in the income expense study is delayed by a year. So actually that was from, just to keep in mind, that was from 2023 and the sales data is from 2024. But the buildings that are sold, they're a tiny fraction of the actual total number of stabilized buildings. So it may in part reflect some of those buildings, but not a majority of them. So it's tough to know if, whether or not it's reliable to look at the sales data figures as opposed to the NOI, which is for all stabilized buildings.
I also think you'd have to look a little more deeply into the components of the NOI, both in terms of geography and building mix types. And as Brian said, I'm not so sure that sales data, the buildings that are being sold may not be fully representative. They might be some of the more healthy buildings. Conversely, they might be some of the buildings that have the lowest NOI and are performing poorly, so more like distressed sales. So.
Right. One of the things, the composition of a building, what's being sold in 2024, that type of building may be different from what's being sold, like I compared it to 5 years ago, in terms of, especially that was at least half the year was before the revision of the rent laws.
I think equally interesting is the transaction volume, which looks like it's down and has gone down the last couple of years. Alex, you would?
Is it possible to know the year in which the buildings were acquired that were sold? I guess what I meant
when they were acquired by the previous owner?
Yeah, so like if buildings were bought, let's say, in the last 10 years versus older buildings, like some buildings may have been bought prior to 2019 in anticipation of deregulation, and they're more speculative, and I'm just hypothesizing, but maybe those were the ones that the business model collapsed and the owners may have sold, versus other buildings may have been under ownership for a long time and could have other motivations for selling. So I don't know if it's possible to know like how long these buildings were actually owned before they were sold. I think might be interesting. The question I have is, the price index. The original income and expense report is time lagged. This data does show more in real time, as does PIOC in terms of more recent trends in 2024. And my understanding is that sales prices reflects both NOI and cap rates, what cap rate the investor wants to use. I don't know if we have any data. I think I asked this last year of what has there been any change in the cap rates that investors are using? Because that could also account for the drop in sales prices.
There absolutely is, because a lot of it's interest rate dependent, right? So cap rates have definitely been adjusted in New York City in the last few years, I know that. I mean, precise data, right, I talked to 10 brokers, you probably get 10 different sort of numbers, but in a range.
Just regarding your first question, we possibly could find out if the building was sold in recent years, if we have that in the data we've gathered for prior analyses of the sales data. If it goes back too far, we probably wouldn't be able to match it up.
How long have you been collecting the sale? You have block and lot or addresses for all the sales you collect, right?
I think that's in the file, yes. I think it goes back to the first year we have, 22 years we have, I believe.
So you have 20 years of data.
Yeah.
I think we talked about this, about maybe going back and seeing that data set if you have buildings that sold more than once during that period. So I think, Alex, that gets a little bit of your question.
But we'd also have the price that it was.
Right.
Sold
right. If
for
it's sold in
usually
2004
too,
for X in 2020, again, it's not dispositive of anything, it's just it's a different data point.
Yeah, I was just going to say, I feel like the sales prices contain current NOI, expected future NOI, and cap rates. So either cap rates went to the moon, expected future NOI went down, or current NOI went down, some mix of the three. I think that's, at least theoretically, has to be true, mechanically. But then the other question I wanted to ask was, is this a repeat sales index? Or is this a simple average annual transaction price?
Yeah, it's the average annual, yeah.
Theoretically, right, with the decline in sales prices, wouldn't that then lead to, like, in the future, lower debt service payments for future owners, which would then result in a higher NOI? Separate and apart from any rental adjustment?
Well, the NOI doesn't actually include debt service when we report it, so it's not really exactly captured, yeah.
Yeah, debt service is a form of capital income. Right.
Other questions?
But either way, even if it doesn't necessarily affect the NOI calculation, you would assume that the debt service would go down, right? With the lower sales price and projected in the future.
I mean, they would, if there's a lower sales price, they
Yeah,
have to borrow less, I presume.
Yeah, that's what I would think too.
Yeah, but interest rates play a role in that as well, right? So, yeah. Okay. Nothing else? Thank you.
Thank you.
The interest rates have declined though, right, recently?
But not from last year, but not from the historic lows of 3% that we saw 5 years ago, right? That's the, right. Oh, good. Do we need to take, do we need to break anybody or keep plowing forward? You're happy to plow forward? Great.
Give us
So
a
who's?
couple minutes
Oh,
to
you
set
need
them
it,
up.
yeah, they need a minute. We're gonna have, who's next? Mr. Riggs. Robert Riggs, please, come to the front. If you're gonna take a minute, I will take a quick minute.
Yeah, or I can.
Yeah, I mean, I'm not an investor's guy, I don't know what's the status, but, you know, we did have conversations, I think Doug was there too, with HPD. And there were some conversations with our lawyer staff, so part of the legal agreement that it was possible. And we talked to Liz Comfort and others, HPD about it, so it was sort of moving along and then Nestor left. We have to step up it. Yeah.
Yeah. When people joke about when you buy a house with a mortgage, the bank owns it, you don't get the deed or pay off. It's so complicated. It's like a co-owner. And they're really and so they're like a co-owner, they still have control over the
Yeah, I mean, that was one of the biggest things I took away from public meetings. The number of people that are complaining about violation or some building issues, and they themselves say, right, why should I pay more in rent? To be taken out of my loan, not going to fix it.
This, I mean, yeah, this is like letting us know what. This report is like what exactly what lenders the passive purchase is.
I know, let's keep talking about it. It's for lunch today.
This is for next year.
Oh, my God, that line dividends. We're going to get lunch today. You know, it's like, that would be funny, it's like, well, dividends are They don't mention NOI here, that NOI excludes debt service.
Will you say that most of the finance
And that's exactly what happened.
that means the respiratory sales are decreasing. So therefore you have to incentive to buy. But because I'm thinking, okay, I'm gonna sell the building. So you have less debt because the interest rates are not going up. This is like a flash. I mean, you didn't just sell the building and you didn't have to get a new insurance for the building, right? So therefore your interest rates are not high as the new building. You compare the new building, kind of.
I'm sorry, the mirroring is that.
An increase on the NOI. Less interest, less capital improvements to be made, because they already made it, with that, about the building. So the second year, whatever. Yeah.
I feel like, I don't want you to know, structure, size of the water flow of where the net operating comes. So let me know, maybe once you get a sense more. And I'm even nice for that. But I don't.
So what I'm trying to say is, it's more equal to the non-profit. We just go now, we are saying that we can spend a little bit more, a higher NOI this year than last year.
All right. All right, are we ready? Oh, we're not ready.
Yeah, but that's between the different parts of the capital plan. That's a negotiation between.
I guess what I'm getting at is like, without having.
All right, I think we're ready to begin.
Before we begin, you do have a printout of this presentation. So if it's easier for you folks to follow along that way, that's great. And just a reminder, if you haven't filled out your menu for next, there's a menu there because it's an all-day meeting next week. So
Please fill that out and get that to me before you leave. Otherwise, you go hungry.
We wouldn't want anybody to be hungry and cranky. I just want to welcome Robert Riggs, the Senior Vice President at the Community Preservation Corporation, responsible for the New York City portfolio. And I think, Robert, this is the second or third year you've testified? Third year. Great. So welcome.
Thank you for inviting me and PPC to testify before the board. Very challenging task in front of you, and it's a privilege to be able to share information. This is the third year in a row I've been here. I like the venue I'm used to is the municipal building, so it's nice to be here at City Planning. So CPC is a 50-year-old community development financial institution founded in 1974 in New York City to address the disinvestment that was happening in that decade to the housing stock. We have since expanded to the state into a national platform. In that last 50 years, we've invested $15 billion from our debt and equity platforms across the country to finance 230 units of housing. Of that, $5 billion and about 100,000 units have been in New York City. So New York City does continue to be our focus, and we, over time know a lot about it. The housing stock, and one thing that we have always done is share our operating information with the affordable housing industry, and when asked with RGB as a resource, a window into how these buildings operate. And it has always been the CPC portfolio and the CPC maintenance and operating standards are a resource to the community. So what is in that portfolio? We service a permanent loan portfolio. The investors are the city and state pension funds, and to a lesser extent, in New York City, Fannie Mae and Freddie Mac. So they're the investors, we're the servicer. The loans in New York City are nearly 100% stabilized units. We have this debate whether or not we can affirmatively say that's 100%, and we can't. There may be instances where there are a handful of units that are not stabilized, but generally speaking, all the units are stabilized. More than half of the projects also have regulatory agreements from city or state agencies, further restricting rents in some cases. So this is, affordable housing, while also being stabilized housing. So our portfolio in New York State includes 183 loans, about $2.4 billion. 600 of those loans are in New York City. All of our operating information is information we get from a survey, so we're dependent on who responds to the survey, and 361 buildings representing 14,600 units and about $900 million of private debt responded to the survey. And so this operating information is from that survey. It is information we collected in 2024 and reflects operations in 2023. So this is our breakdown of kind of the main operating lines and a percent change over 2022. I'll start at the bottom with our kind of summary per unit operating costs are about $9,500. Significantly, this excludes taxes. The reason we exclude taxes is that, as I mentioned, over half of these projects have tax abatements that either fully or partially abate the taxes, so it's a variable that doesn't apply and it's not informative to the broader stock, so we take it out. $9,532 per unit, just over 6% increase since 2022. And if you look at the lines with big increases, you see the dreaded insurance line. It does continue. I was listening to the conversation earlier. I agree it's a national issue. Locally, it's an issue driven in part by the lack of insurers that stayed in the market. But I just also add that the feedback we get is unique to New York. There's a very significant spike in construction costs, which means that any property insurance claim is much more expensive to fix than it was, in previous years. And also ongoing concern about the cost specifically of liability as opposed to property insurance in New York, and that does relate to the kind of the environment in New York City that, in particular, that results in high payouts through lawsuits, liability lawsuits.
Rob?
Yes.
Can I ask a question? Do you mind getting questions?
No,
right?
please. Yeah.
So is there any other thing in these expense components that would differ from other types of multifamily housing that's not in your portfolio? Is, for example, payroll and benefits, is that more non-union than union, or is that a mix? Or?
It's more non-union than union. It's a mix. It's more non-union than union. And on the expense side, there really shouldn't be much in here that would differ from a typical rent-stabilized building. So then the other kind of thing that jumps out at me is the actual what's going down. So advertising and marketing, it was only $12, but much more significantly, repairs and maintenance, which is one of the largest expense lines, and we're seeing a decline of almost 10%. So why, in an environment where everything is going up, and certainly labor and materials is going up, would that be coming down? And so that does raise the question of, is that a flag for deferred maintenance? And changes in behavior by owners about when they're investing in repairs and maintenance. I will say that it went up about 10% in 2022. So this is actually a return back to where it was in 2020 and 2021. So maybe there was a spike in investments that happened in 2022, and now we're seeing a return to normal. That doesn't seem likely to me, but that's just my opinion. So I don't have an answer to that, but it is a very interesting negative number on this slide. So this is our operating expenses for the last 4 years, and the 6.1 increase on the right that we just talked about on top of previous year's increases. And this is the gray is actually the maintenance and repair line. So it is going up, but you don't see the big jump visually in this table. And then this on the left is what I just showed you, collapsed into a smaller table. And then on the right is our summary of the RGB expense data. I think it's an average of the pre-74 and post-74, so I'm sure they don't exactly agree with this, but materially, like, this is ours compared to yours. Your expenses are slightly higher, and you're showing this. But over the 4 years, it's exactly the same, 21%. So a look back of 4 years is quite consistent. Even if the numbers themselves are not in alignment, they're close but not in alignment, the overall trend is actually completely matches. And again, we've excluded taxes from both sets of data. So then one thing that actually doesn't come up on the expense side, but I think of almost as an expense, is collections. And in the affordable world, and I think to a great extent in the stabilized world, pre-COVID, collections were very, very good. It was just kind of a rule of thumb. You were in a below-market unit. Residents understood the importance of that. It was almost a form of equity that they would defend, and people paid their rents. So if you had physical occupancy, you had good collections. And in fact, the underwriting standard was always to assume 5% collections losses, and buildings routinely outperformed. So they were collecting 97%. And actually, Freddie and Fannie and some of the regional banks got a little more aggressive and would underwrite to 3 or even 2% collections losses, because in below market units, it was just a rule of thumb. So that, with the pandemic, like, that broke. And you see it on the graph where collections in our buildings, I should say this is not from the data set I'm talking about. This is from a much smaller group of loans. It's our construction portfolio where we're monitoring month to month. So this is almost anecdotal, but it is material. It was not, and we also talked to our borrowers, they have portfolios, we talk to them about this all the time. So collections dropped typically as low as 70% or in the low 70s, which is a huge decrease in income. It is understandable why. This tenancy was directly exposed to the economic fallout from the pandemic. Lots of service workers, restaurant workers, hotel workers who their income evaporated. It has been very slow to recover. So when I talk to people now, they're saying, well, 92%, 91%, 90%, they're backups. That's a significant recovery, but it is not back to where it was, and there is an ongoing kind of stress in the system of this change. And I will tell you that when we were trying to start to report on it, we didn't even have the right reports because it was something that was so taken for granted, separating arrears from collections and et cetera. So this continues, the line is going in the right direction, but it's not back where it was. And so rising expenses also have to take into account revenue declines coming from collections losses, which are still a bigger problem than not as big a problem as they were 3 years ago, but they weren't a problem at all pre-pandemic. So what do we see in our book in terms of stress? So, for the last several years, I've testified the last 2 years here that we're concerned about about rising expenses and the impact on buildings' ability to have sufficient revenue to operate, maintain their buildings, and service their debt. So this data is actually most of this data is about performance in the portfolio and actions taken by the lender. So this is actually from 2024 calendar year, so the loan count's slightly different. And we're tracking enforcement actions we're taking, delinquencies of more than 60 days in the portfolio, and reported debt service coverage ratios that give us cause for concern. So the kind of most acute of those is obviously legal action we're taking. So the table at the bottom shows it has information from March of 2024 because I talked about it last year here, so that matches what I presented last year, and then it has information from December of 2024. So you could think of this as the beginning of 2024 and the end of 2024. We had accelerated, which is a formal, demand on the loan, and is a precursor to foreclosure. We had accelerated 10 loans, and we were in foreclosure on 2, for a total of 12 legal actions. So at the end of the year, we were in foreclosure on 14, so presumably all those 10, the 2 and 2 more, and we've got 2 more accelerated. So this is a jump from 1.9 to 2.7. It's almost 3% of the UPB, and it's 3.5% of the units. Those seem like not shockingly high numbers, but this portfolio was very conservatively underwritten, has long-term fixed rate debt and regulatory agreements. We would typically see almost no accelerations or foreclosure. And in fact, in 2019 to 2022, we had no activity. Now that was in part because of the pandemic, but this level of legal action is concerning for us and not typical of past performance of the portfolio. Unpaid principal balance is the outstanding debt. So, when we're thinking about what's going to happen in the future, what is a precursor to legal action? And it's probably delinquency. So again, the table at the bottom is from 2024 because we know every month who's paying and who's not paying. We're not relying on them to tell us. And our delinquency, our DQ rate on loan count was 9%, on UPB was 8%, on units was 9%. In 2022, the DQ rate was 2.7%. In 2023, it was 3.7%. So this is a doubling from last year, and is evidence of stress. And then what's a precursor to delinquency? It's debt service coverage that's declining. So this information, again, I'm sorry to switch back, but it's from the 2023 survey because we rely on owners to tell us. And this is a measure of owners reporting debt service coverage below 1.0, which means they do not have sufficient net operating income to service their debt without coming out of pocket. Doesn't mean they're going to go into default, but it's not a good sign. So it's jumped from 11% in 2022 to 28% in 2023. So that, I almost think of this as the pipeline of future foreclosures, right? First, their NOI goes away. Second, they stop paying. Third, they go into foreclosure. We are watching their tax payments and their water sewer payments, so we won't let them go delinquent on those. We will force those. We'll pay them ourselves if we have to, but you see it in the payment defaults. So none of that data includes loans that we serviced that were formerly part of the Signature loan portfolio. But I know that's of great interest. I do have some information on it as part of the presentation. So CPC is the managing member of an entity that does business as Community Stabilization Partners, and I'll call it CSP. CSP, in turn, is the managing member of a joint venture with the FDIC that owns, manages, and services a big subset of a significant portion of the old Signature multifamily loan book. There are other JVs with other managers. The portion of the portfolio that we are involved in was, the conventional wisdom was it was the more distressed portion of the portfolio. It's the debt is secured by about 1,100 New York City multifamily buildings. It's about 35,000 residential units. Approximately 80% of those are stabilized. So not the 100% stabilized from our book, but significant majority stabilized. This is a heat map of where they are and the kind of counts as of November. So not when we acquired in 2023, but November 2024. It's 848 loans, 31,000 units, $5.6 billion. And it's spread wherever there is old multifamily stock and stabilized units, that's where it is. So to me, as an affordable lender, our book is much more concentrated in the more affordable neighborhoods and markets in New York City. The Signature book, to my eye, as an affordable lender, is much more spread out with a lot of units on the Lower East Side, a lot of units on the Upper East and West Side, and in stronger markets in Brooklyn. So we have expense information, not from the whole, we have reliable, good, vetted expense information, not from the whole portfolio, but for 150 of the units, 150 of the loans. So it's pushing, let's say, 20% of the portfolio. And this is mislabeled. The information we have is actually from 2024, not 2023. So this, and then the non-CSP, when it says non-CSP, that's our book that I was talking about earlier. It's from 2023, so this is not exactly apples to apples. Column on the left, recent reliable operating information from a significant portion of the CSP or Signature portfolio. The column on the right is the 23 information from our book. But they're consistent, slightly more expensive, just a couple $100 off in the total. See the same big property insurance line. Actually higher repair and maintenance in the Signature book than in the CBC book. I don't have year over year, so I can't show you any changes, but I'll show you next year. And I'll have a bigger sample. So we do track. We know that this is a distressed portfolio. We knew it when we got into it. So we do track it a little differently. This is a table of financial distress over the last 4 quarters. So not the last 4 years. This is February 2023 February 2024 to November 2024. The darker. This is financial distress. The darker part of the bar at the bottom is 60 days DQ. So these are DQ loans. 24% of the loans are DQ. So remember, I was alarmed in our book that 9% of the loans were DQ. This is more than double that. The part of the bar above it are loans where, based on the information they've given us, the loans are current, but we think they have unsatisfactory debt service coverage or loan to value. A lot of that information comes from the original Signature tape and hasn't been vetted, but the line is going in the wrong direction, and 2/3 of the book has some flag of financial concern, and almost 1/4 of it is actually in default, in payment default. Okay, we also track what I'll call physical distress. So we are monitoring B and C violations per unit, we're monitoring ERP charges per unit, we're monitoring civil penalties. So I'll start at the top. The light blue part of the bar, those are the portion of the loans that have more than one B or C unit, more than one B or C violation per unit. So an unacceptable level of B and C violations. The next one down, the smaller light blue, is more than $50 a unit in ERP charges within the last year. And the dark blue is both of those things, high ERP charges and high violations. And then the almost black at the bottom is loans with civil penalties. So again, not going in the right direction, and in particularly the loans that have both ERP and violation charges from 8% to 12%, that's a 50% increase. And what we would expect, kind of our working theory of the case, is financial distress will be followed by physical distress. And if we are going to stabilize these buildings, we have to address both. And then I don't have a slide on it, but there's this question of, why is this book performing worse than the CPC book? So this is the Signature portfolio. Signature was a regional bank that was aggressive in the market pre-2019 when most of these loans were originated. These loans are carrying significantly higher amounts of private debt than the debt in our book, It's actually averages about 180,000 a unit, and the debt in the CPC portfolio is about 60,000 a unit, so much less. So there's some reasons for that. One is that our book is, remember, it's affordable housing with regulatory agreements, so the rents are just lower. It's also financed with long-term fixed rate financing from the pension funds, which is more expensive and can leverage less debt. And it's supported with subsidy, so there's public debt behind that private debt. On the CSP side, or the signature side, this is private debt that was originated in an environment of very low rates and very low cap rates that allowed conventional lenders to put more debt on the buildings. I would also say the buildings have more market rate units and they're in stronger markets, so that component does generate more net operating income. They also have retail spaces that some of them in very valuable neighborhoods, so that you've got the non-residential portion generating revenue that can cross-subsidize the value of the building. So there are a number of reasons. And then the last thing I point out is listening with great interest to the average sales prices. $180,000 a unit seems like a lot of debt. Seems like a lot of debt to me. And it certainly seems like a lot of debt in comparison to the 60 grand a unit. But if the average sales price was, I think, 280 a unit, that's not crazy. Nonetheless, these buildings are over leveraged, or you wouldn't see these high collections rates. And I think my point is that I'd like to make is that you can say, well, this distress is the result of aggressive behavior by the lenders and the owners pre-2019, and that's not wrong. But it's not entirely, because the counterexample would be the CPC book, which is all of regulated affordable housing. So there's more distress here. 24% delinquency is much worse than 9% delinquency, but 9% delinquency is bad, and it's going to get worse, and I think this is going to get worse too. And then one last thing, there's so many ways into this data. This is a conversation that I often have with both owners and with tenant advocates. So I just thought I'd kind of go through the math, which is how much does it take to operate a building, and how does that relate to rents? The minimum, I don't want to call it the minimum rent, but how much of the rent is eaten up by operating costs? And broadly speaking, based on our operating numbers, about $1,250 of rent goes to operate the buildings. So that's just the annual operating expenses. $10,046 is an average of RGBs and hours, but it's about $10,000. Remember, we'd excluded taxes, so I added it back in. There should be a capital reserve added annually. A lender would require it. We require it on all of our loans. It belongs to the building, not the owner. And then remember, you're not collecting all of that. We've got collections losses of 10%. So say you're not collecting 7.5%. So the lease rent required to cover expenses is about $1,200. If the rent is lower than that, the unit's not covering its operating costs. I'm not suggesting all units should cover their operating costs. There are some units with higher rents, and there are market rate units that'll all contribute to value in their own way. But this is and thinking back to that table of your increases and our increases over the last 3 years were 21%. If I drop this 21% and run the numbers, it comes out to $1,000 a month, not $1,250. So as those expenses go up, this is how it relates to rents. And as it puts pressure on NOI, we expect to see deferred maintenance, tax liens, mortgage defaults, and bank foreclosures. We as a lender are starting to see all four of those things, and I expect that trend to continue. I'm happy to discuss or take questions.
Sure, I'm sure there will be. We'll look around the room for questions from board members. Arpit, please.
Yeah, thank you so much, Robert, for your testimony. I'm wondering if you can comment on new loans that you're making and kind of what you're appraising these properties at, right? So one of the items we saw this morning was a dramatic decline in sales prices of rent-stabilized units. And then we had a discussion about, is that selection or is that genuine value, and is that value reflective of current NOI, future NOI, cap rates, et cetera? So I'm just curious, when you look at a property and you appraise that property to put a mortgage on it, what are you kind of typically appraising it at? Are you seeing the same declines in appraisal values, or are they more stable to you? How are kind of cap rates? How do you kind of think about the appraisal process?
I think it's really a question about value, like what are the values in the market and how is that impacting the ability to leverage debt? So we do see significantly higher cap rates Now in part that's because cap rates were absurdly low in 2017 and 2018, like sub 3% cap rates, which is not healthy. I mean, in my opinion, not healthy. It's a fact that that's where they were. My opinion is that's like not healthy, and it created these valuations that weren't really supportable. And whether they might have been supportable in a different world, they're not supportable in this world in light of the 2019 stabilization reforms and inflation and the interest rate environment. So we see cap rates now, depends on who you ask, but cap rates now are between for stabilized buildings are between 6.5% and 7%. So that's cutting the value in half, and that's what's driving those acquisition prices being so low. Now is a terrible time to sell a building in New York City. So then, I think there was some discussion earlier about so that's all based on net operating income, right? The net operating income, the cap rate would be applied to the net operating income, and values are down because cap rates are up. But once you get past that, now you have to use that net operating income to leverage debt. And I was looking at the interest rate chart, and the interest rates of 6.5% are down from last year, and they're down from 1985, but they're way up from over the last 5 years, right? So another pressure point is a lot of buildings that were leveraged in 2018 by Signature and other lenders now are having to refinance or face a rate adjustment to 7.5, to plus from 3.5 to 6.5, right? Might be, and a lot of the sales that I see are forced sales because of that at very low prices. Although to your point, there is the owner's equity is gone. The bank is probably taking a loss, and the day of that acquisition, the value is reset, and it should be sustainable if it's properly underwritten, depending on what happens to the environment. So it's a painful reset, but it is a reset. And in terms of, we still underwrite the same way we would our metrics. We'll take the NOI, and the interest rate available now is 6.5 instead of 4, so it just carries less debt. The NOI might be down if it's a 100% stabilized building that's had significant operating costs. So it's harder, the value is going to be lower in the first place, and then it's harder to leverage debt in the current interest rate environment. But we're lending to the same 125 debt service coverage, 80% LTV. It's just the LTV is going to be lower because of cap rates, and the proceeds are going to be lower on debt service coverage because the rate is 250 basis points higher than it was in 2018.
Other questions? Oh, go ahead.
Oh, yeah, just as an upshot, do you have an action, what's the actionable upshot that you would like us to consider as a result of that?
Well, it's a question of, the RGB doesn't control a lot of things. You can't change insurance costs. You can't change interest rates. You can't change the cost of labor. You can't postpone tariffs. I also would say there's, no reasonable action by the RGB is going to reverse, declining NOI attributable to this. But, I would ask you to consider the increases in costs in expenses. The declining NOI, if it's not being offset by other things, will result in distress in the housing stock that's bad for the housing stock, bad for the owners, and bad for the tenants. I would be frustrated by someone who's invested in the stability of all of that system, by a slightly lower rent increase as opposed to a slightly higher rent increase.
I'll just say, while I appreciate that, your portfolio is 2.2% or 2.2%, I think, of the entire stock. We're not here to make an adjustment based off of CPC's portfolio necessarily, although I understand the value that you're trying to bring to this presentation. And I think we would disagree about the impacts and the purpose of the 2019 rent laws and to what degree over leveraging and business decisions and speculation had an effect on the current situation now. I think the current situation in terms of physical distress is a real one, but I still maintain that when wages are not going up, when things in 100% units, rent stabilized buildings specifically, are just completely unaffordable. I don't think that the answer, considering you just admitted, and I would agree with you, that this board's job is not to make policy, it is not to deal with insurance rates, et cetera. I don't think that the answer is an increased rental adjustment, as you just put forth, on working class folks.
Those are all good points, and I'd also say that I acknowledge that I'm a lender, and I have a financial stake in the buildings, and there's going to be the owners and lenders are going to absorb a lot of pain, and that's not inappropriate. That's not inappropriate.
Okay, Alex S.
Thank you very much for the presentation. So last year, your presentation was grim. This year was grim too. I guess my question is, if things are about the same as last year or worse?
Well, we have higher levels of legal action. We have higher levels of payment defaults, and we have higher levels of indicators of financial distress in terms of like net operating income. In the CSP or the signature portfolio, which we approached as a distressed portfolio, we're seeing increases in violations in ERP charges. And we're going to start monitoring our portfolio for those kind of building condition reports, which is not something we've done in the past. So we're changing our behavior, and we expect more. I think it's going to get worse before it gets better.
On that point, Robert, we are interested, all of us, but I think I know it's something that I've thought a lot about indicators of physical distress, and not so easy to ascertain, right? We all know violations is an imperfect measure. We all know deferred maintenance is hard to measure, though some of the numbers you show, you're right, indicate the possibility. Maybe one thing I would ask to think about is how you might suggest, both for your portfolio, but then maybe when you come back next year for some recommendations for us about how to better measure physical distress.
Yeah, no, it's very tough. I'll just tell you internally,
I know that, but you guys are smart. Come on.
The violations are a starting point. The ERP charges, and we also hear from community tenant groups and community associations, elected officials, the New York Post. There's plenty of parties out there highlighting physical distress, and so we have a regime of, if it gets to priority, we'll send an engineer out to walk through. Depending on what the engineer decides, we'll send a better engineer out to walk through. So it's kind of an escalating thing, and it's something that we have to do as a servicer, and as a lender, and as someone with an interest in both an economic and kind of a mission interest in the health of the stock. We're inventing, but it's a lot of elbow grease as opposed to
right,
scraping data. So
it's much more than data analytics. Yeah, I agree. Yeah. So I would maybe thinking the way you just did it was interesting, almost like a red, green, yellow type, or some kind of system of like you can measure financial distress pretty accurately because you have all that data. I recognize you're not going to have all that data for physical, but to think about some methodology. Yeah. Obviously for you it's important, but I think also broadly it's important as we sort of think about these issues. Thank you.
Thank you.
I think, right, Lucy and team? Are you using a laptop? Okay.
Nice camera forward.
We're on track, right? 5 minutes behind. We're doing well. Yeah. Okay.
This one, red light when it's on.
I'll let you get settled. Do you need the PowerPoint or no? Okay, great. welcome. I want to welcome now the Department of Housing Preservation and Development, Deputy Commissioner Lucy Jaffe for Policy and Strategy, love that, and Dr. Elizabeth Gomer, the Assistant Commissioner for Research and Evaluation. Thank you for coming. I know this is certainly second, third, fourth. I mean, Liz probably for 20th time.
We don't acknowledge how long I've been doing this.
So welcome, yes, welcome.
My sixth. So.
Sixth? Is it really? Wow. Congratulations.
You should all issue badges. I think you should.
Andrew, that'll be your job. Thank you.
Okay, do I have this on? Have it now. Okay. Good morning, Chair Apple and members of the Rent Guidelines Board. I am Lucy Jaffe, Deputy Commissioner for Policy and Strategy for the New York City Department of Housing Preservation and Development. I am joined by my colleague, Dr. Elizabeth Gomer, Assistant Commissioner for Research and Evaluation. As always, I am grateful for the invitation to provide testimony during this process. HPD's mission is to promote quality and affordability in the city's housing and diversity and strength in the city's neighborhoods. Rent-stabilized properties comprise 1/4 of New York City homes, and almost half of rented New York City homes, and roughly 1/4 of the rent-stabilized housing stock is affordable rental housing regulated by HPD and subject to the annual orders issued by this board. For these reasons, a key component of HPD's work involves ensuring the quality, safety, and ongoing viability of our rent-stabilized housing, and we dedicate significant time and resources to studying rent stabilization and responding to changes within the context of our broader housing market. Moreover, the three objectives referenced in HPD's mission, our focus on building quality, residential affordability, and neighborhood strength, require HPD to view rent stabilization through all critical stakeholder lenses. Current and future rent-stabilized tenants, owners of rent-stabilized properties, and communities containing rent-stabilized buildings. This perspective is one that HPD and the Rent Guidelines Board share, and it is unique among contributors to this process, many of whom represent narrower interests. Through our research and policy work, and given the unique view that this work provides us, we have come to appreciate one of the most important potential benefits of rent stabilization and of this board's task, to ensure greater stability for owners and tenants through predictable annual rent increases. Turning to the current moment, this is a period of unusual uncertainty. Over the last 5 years, New York City experienced major changes to our rent stabilization laws, the havoc of the COVID-19 pandemic, supply chain and labor shortages, rising interest rates, and an insurance crisis, each with significant impacts on the housing market, compounded by a lapsed J51. We have also seen both our highest vacancy rate in decades and our lowest, in 2023 at just 1.41%. These impacts affect not just rent-stabilized properties. Every type of housing in New York City feels the strain, from affordable rentals to home ownership. As we know from conversations with colleagues across the country, New York City is not alone. Rising costs, plus the widespread harm caused by tariffs and other changes on the federal level, will exacerbate problems exponentially for building owners and occupants alike. Such disruptions compound both acute and persistent challenges for tenants. High levels of food insecurity, increased reliance on public programs, including rental assistance, and chronically high levels of rent burden. Tenants in New York City seeking to move face an ever-shrinking number of available units at dramatically higher rent levels. We have seen the long-term result, displacement, with a net loss of our lowest-income New Yorkers as they exit our city and a net increase of wealthier residents as they enter and replace them. Owners and tenants will argue that these extraordinary circumstances warrant an annual rent increase that would remedy the magnitude of this moment. We have come to appreciate, however, that it is incredibly difficult for this board to respond in a given year with such a precisely calibrated annual increase. Even the most accurate data cannot necessarily be reconciled to produce an outcome that appropriately matches the challenges that both tenants and owners are experiencing. Instead, we encourage the board to think differently about the task of setting rents, prioritizing stability for the benefit of both owners and tenants through reasonable and predictable rent increases year over year. With such a focus, neither owners nor tenants will win every year, but they will benefit from a steady approach and the absence of extreme fluctuations. Across a system of almost 1 million homes, there will be both owners for whom any reasonable increase will be too low, and tenants for whom any reasonable increase will be too high. But this board's role, like HPD's, is to look at the system as a whole. Annual rent increases alone cannot resolve distress. For owners and tenants who are struggling, HPD provides more tailored programs. We offer a wide range of preservation tools, including revamped lighter touch tools, such as J51 and unlocking doors, to respond to the feedback we have heard from owners. We are working to improve our capacity to provide technical assistance to owners. We take action through enforcement programs when necessary against bad actor landlords who place tenants at risk. We've expanded Partners in Preservation to support 16 community-based organizations in growing their tenant organizing in more than 30 community districts. We manage rental assistance programs that, alongside senior citizen rent increase exemptions and disability rent increase exemptions, help tenants manage high rents and also benefit owners. The unpredictability of a very constrained housing market can be crushing. Good housing policy ensures stability, which benefits both tenants and owners. When rent increases are predictable, everyone can better plan for the future. Owners can more confidently seek and make medium and longer-term investments, which promote healthy building management and quality living spaces. Residents reap those benefits and can also plan financially around a rent amount that they can reasonably foresee, enabling them to remain in their homes and in the city. For these reasons, we urge the board to take a longitudinal view of rent stabilization, focusing less on year-over-year changes in owners' and tenants' circumstances, and instead on how rent stabilization best serves its various stakeholders, and how to create stability through predictability. Thank you for this opportunity to testify. We look forward to further collaboration with this board and are available to answer any questions you might have.
Questions? Alex?
Hi, thank you very much. So did I hear you say that about 1/4 of the rent stabilized the rent stabilized stock has some involvement with HPD? So that's about, what, 250-something thousand units?
Yes,
Is it
that's about
possible to
right.
get a breakdown of those units by program? Or also, I'd be interested to know how much is under nonprofit management ownership compared to for-profit? So I think it's just an important point because there's the notion that the vast majority of rent-stabilized housing is under private for-profit ownership. And this is a significant percentage, and I don't think there's been very much discussion of that.
Sure, we can certainly break it down by program. I'm going to cautiously say yes, we can break it down by nonprofit management, and we're happy to get back to you.
Okay, thank you.
Yeah, thank you. I appreciate your comments on stability and predictability. I always think of the memory of Richard Ravitch and the MTA. Like, the MTA got itself into trouble over the years by, not always keeping fares stable and with inflation, and then would do a jagged, massive increase, and it would, and then, they basically, Ravitch thought was like we should be stable and predictable with these important, public things, and so, did you have any implied range of what you mean by stable and predictable, or basically what does your research team, what does that look like for you guys?
Thank you for that question. Am I still on? All right. Or you can just hear me. Thank you for that question. We have always been I'd say we're not independent. You all are independent from us, and we respect that independence very carefully. Our role is to work with you all. We work very closely with the Rent Guidelines Board staff to share and provide data. We encourage the board to look at the long history of how rent increases have gone over time, right? And taking a look at the sort of the ups and the downs and thinking about it maybe less as a year over year, and then that might sort of result in a need to switch back. And that's what we would encourage the board to do, but we're also continue to respect the independence of this board and your the data that has been provided to you and that we can provide if asked for.
I wanted to ask, you referenced some of the tools you have. Can you talk a little bit about that, and with some particular focus on J51?
We are eager to talk about J51 because we are in an important moment. As you all may be aware, J51 lapsed in 2022. It is one of our few as of right preservation-focused programs. The city spent a while working very closely and actively with our partners at the state to get it reintroduced. It passed in 2023 and was implemented by the city council action in late 2024. Owners may now apply both for work that has been that was done since the lapse in June 2022. There is a short window for that, and then it will be in effect until 2026. The new J51 has been revamped. It had been allowed to get a little stale. Costs were not quite keeping up. When we, in the new version, the reformed version, I'm told I'm supposed to call it J51R, I will eventually get that down. It is actually much easier for HPD to update the certified reasonable cost schedule. So we hope to not let it get stale again. We view this as a very important tool for owners to be able to make major capital improvements, and its lapse at a time when folks needed it most was incredibly impactful. That being said, the J51R was only passed for a period of 4 years. So we now have a program that will lapse in 2026. We hope that the state legislature will recognize that this is a limit for building owners to be able to plan for, and we hope to work with them to ensure that we get a long-term approach that allows everybody to plan ahead, and that is a top priority to make sure that we do not let this lapse again.
Could you share some data with us on both going back to the J51 program? And my guess is you have very little data, because I would imagine that because it was just timeline, it was passed by the council, which allowed you to effectuate it only like last year?
Yes, it was December 2024, so we are in the period where we're sort of in the runoff period where people can apply for work that
Retroactively.
Thank you, better word than runoff, retroactively.
Under the new
Under the new
cost structure.
Yes.
Okay, so even if I did the work in 2023, in theory, I can go back and apply for that.
Yes, and we hope that you will. Otherwise, for work that is happening now, there's a 6-month period owners should apply within 6 months of completing the work, which facilitates our review. And the program is in effect through mid-2026.
So really only another 18 months?
Yes.
Less?
Yes. It is too soon for us to share publicly data. We have been open and up and running for a couple weeks, but we look forward to doing that when we have
Real-time data?
Well, we're not yet at that point.
I understand.
Where our
I understand.
systems are there, I'm sure you're all very surprised to hear that. But we absolutely will be sharing that information publicly when we have it. I can, say that the old J51, even despite the fact that it had become somewhat, somewhat stale, was a widely used tool for a long period of time. It has been with us for decades.
Right.
In terms of the prior usage, we thank you. Well, I'll start with, there's a wide range of eligibility. We estimate that something in the neighborhood of 700,000 units are in potentially eligible buildings. About 71% of those units are rental units. Just under 30% are in co-ops and condos. In terms of prior usage, we saw pretty equitable usage across the various boroughs. Manhattan, Brooklyn, Bronx, and Queens in particular. In the neighborhood of 50 to 100,000 units used it in each borough, in each of those 4 boroughs. Staten Island is a bit different, of course. I think that
Yeah,
Yeah.
and we're happy to provide additional historical analysis, which we've done. I will just add that, as you may know, in the revision J51R, not J52, J50R, that we also have done, I think, a better job, more effective job at targeting this, particularly for rent-stabilized buildings that are perhaps would benefit the most from the tax abatement. So that includes generally lower rent units, where a majority of units are rent stabilized. We estimate that the eligibility for that is about 350,000 units, and that we're going to be watching that very closely to see who applies.
Thank you. I'm actually going to jump back in with a little bit more clarity. In the last 15 years, J51 was used by 9,600 buildings, covering 305,000 homes. And there was, as well, a split, rental, condo, co-op. We can provide sort of more of that detail if helpful, but I wanted to clarify that total number.
Yeah.
Yes.
And also, how would the new J51 affect those units without, or those buildings without cash reserves that could do the repairs? Because I think that that's a big issue. I know, at least for a lot of my, the landlords that I represent, and if you think of the housing stock in core Bronx, Upper Manhattan, where these buildings need, they need the help.
Yep, absolutely. It is one of the reasons why we talk about the lapse of J51 during this critical period before, in some ways before we saw sort of the compounding effects of some of these factors was such a loss. This is one of the lighter touch programs. It is not an upfront cash program. It would need to be coupled with other sources for buildings that are struggling to obtain capital financing. That being said, for buildings that need more than J51, we have HPD's preservation programs, and we really encourage buildings that are experiencing higher levels of distress to come to us, and we can be a resource.
Can I just, we do have significant numbers about J51 in our housing supply report. So that'll be coming out next month.
So we may have it already.
I believe so.
Could you also provide a brief update on where things are with the Neighborhood Pillars program, which I understand has been very slow in coming, but the idea was to allow nonprofits to acquire distressed rent-stabilized housing owned by usually for-profit owners?
It could be buildings that are acquired under a wide range of circumstances. Neighborhood Pillars is a program that we've had for several years, and we are in the process of investing some more money in it, and we're looking forward over the next couple of months to working with owners who are looking to acquire buildings. It is ramping up now, and again, I would say a little too soon to provide particularly helpful data on that, but we certainly will as we have it.
Okay, thanks.
It might be legal.
Yeah, so you mentioned that we should consider a longitudinal review of the rents. And then on our income and expense report, I noticed the NOI went up about 48%. The rent went up 36.5, income 30, anyways. The NOI went up 48%. So I'm thinking, if we are doing a loan review, should we then be doing a side-to-side comparison of how much the rent increased and how much the NOI increased? Because if looking that way, then we should be considering a rent freeze, right? Would you say that? Or at least a rent increase to match the NOI side to side?
So that report was issued by the Rent Guidelines Board. Rent Guidelines Board staff are better equipped to speak to it than we are. What we would say is that as housers and researchers and the amateur researcher, we believe in looking at all of the available factors and data and understanding what's going on in the market. NOI is one factor. Net operating income is one factor to consider, but we would say it's only one. And when we say to take the longitudinal view, I think what we're saying is that this isn't about what NOI or rent increases or any other factors in any very specific year, that there's sort of a mismatch in time and space and precision with that. And instead that the goal of this board is to set steady increases year over year that everyone can plan around and can have some ability to predict and expect. And that's sort of one individual factor, we wouldn't say lends itself either to a freeze or to a particularly high increase, but that it is a totality of the circumstances, and that sort of lends us towards that sort of predictability of the increases approach.
I just wanted to ask one more question of the, we had testimony from NYU Furman before that was focused on underwater buildings and then rent-regulated 100% affordable buildings. And I think the testimony kind of implied that when we set increases smaller than the AMI increase, that we're putting additional pressure on the 100% affordable stock. That was one piece of testimony. I was curious if HPD has a view on that. Like, does it matter if we keep up with the AMI increases? Like, that's what the federal government thinks is appropriate. What, does HPD have a view on HPD assisted 100% affordable?
So area median income is a source of significant confusion. We call it also HUD income limits, which helps clarify a bit more because it is not actually reflective of area median income. We can actually start with Dr. Dahmer explaining where AMI comes from, because it is a source of significant confusion, as maybe the first.
Sure. So just so that we're sort of all on the same page, but in the context of this specific question. What's sort of colloquially referred to as AMI, area median income, of course, not actually based on incomes for New York City because we have a high housing cost adjustment factor. So it in fact is based on FMR, or fair market rents, which is also not actually market rents. Some of the names lead to the confusion of what we're talking about. So FMRs are set by HUD, right, for our FMRA, which includes New York City and some outlying counties. And it is essentially, is a very simple version of this, but essentially the 40th percentile of rents for recent movers in any type of housing, with only sort of very extreme exclusions. And then there are a lot of other adjustments and sort of technical things that are done to that. FMR is the basis for many different parts of housing policy, in particular payment standards for voucher holders. But because essentially the most core part of those calculations is based on recent movers, it means that they are set at very, very high rent levels. We know from the Housing and Vacancy Survey, right, which I lead, that we have a very tight market. It is tight across the board, but that where we do have the small number of available units that are on the market for rent, they are significantly higher rent levels than what most New Yorkers experience who have lived in their homes for a long time, thanks in part to this board. So that means by definition, recent movers are largely moving into very high cost units in New York City, right? And so FMRs are high. That's a really critical thing to have very high payment standards for voucher holders that gives them a competitive edge when they're also competing with private residents without assistance for those same units. It is important as underwriting criteria to make sure that there's appropriate levels of subsidy, that we can continue to add to the stock of affordable and subsidized housing. But it is not actually any measure of what it costs to live in New York City, the current rent levels, nor part of what it takes to operate, to own and operate and maintain housing. So while FMR is very important and factors into a lot of things, I don't know that using that as a gauge for what is appropriate for rent increases really makes a lot of sense to us.
And I'll add that if we have looked at many indices compared over the years as we think about all of our policy work. If we had one that we could point to that we thought appropriately captured exactly how rents should increase, I promise we would bring it here. I will also say that we talk to our colleagues across the country, and there are challenges. The challenges that we are seeing, the very real challenges that we're seeing in our housing stock, are also being seen in affordable housing across the country, where many of those systems are relying on AMI increases. huddle/AMI increases. This is not a one-size-fits-all, I think, approach either. And so we would sort of caution any reliance on any one indicator as the way to approach this.
I think with that, I want to thank you for your testimony, and I look forward to the follow-up. Thank you.
Thank you very much.
Okay. HCR or Columbia?
Yeah.
Oh, Columbia. So the Columbia, right. I'm not sure who's here today. Is that Sophie?
She's not coming.
Oh.
She's here.
Oh, Ryan and Anastasia. Thanks. Thank you. Andrew Wood.
I'm holding one for you.
Good morning. Thank you for coming. I want to introduce Ryan Vind, sorry, and Anastasia Kotvas from the Columbia Center on Poverty and Social Policy. I want to thank you for coming. I've been a fan of your poverty tracker for a number of years, so we're really glad that you would come today to talk about this.
Thank you
So
for having us.
Yeah, that's great to hear. Thank you so much, Board and Chair Apple, for having us. We have provided some written testimony and things like that in the past, but this is actually our first time presenting to the Board. So we're here today to, as Chair Apple mentioned, provide some insights from the poverty tracker, specifically in relation to an analysis of the recent economic challenges faced by New York City families in rent-stabilized housing, and we'll be diving into a range of different outcomes for this population. Before we dive deeper into kind of some of these questions, I think it's important to just take a step back and understand kind of some background around the poverty tracker for those that are unfamiliar. And so this project actually began a number of years ago when the Robin Hood Foundation actually approached some faculty members from Columbia School of Social Work with the idea of creating some sort of new study with kind of three major goals in mind. The first being getting a better measure of poverty in New York City. The second being to provide a more comprehensive understanding of disadvantage beyond just poverty, and we'll go into that further about some of these other measures that we'll look at. And then finally, understanding the dynamics of poverty and disadvantage over time, and specifically how these experiences respond to policy interventions and other life events and circumstances. But I'll pass the next slide to Anastasia.
Yeah, thank you, Ryan. So some continued detail and background on the poverty tracker study design. So at the moment, we interview about or more than 3,000 households up to 3 times a year for up to 7 years at a time. And we have a longitudinal study design, which means that we check in with the same New Yorkers from each of our cohorts multiple times throughout the year over several years. And we collect key information on different economic indicators from poverty to hardship, at multiple points over time throughout the year and over years. And while we collect about a lot of information on economic indicators, we also generally focus on how New Yorkers, their well-being is doing, life changes, and the ways that policies and programs interact with poverty and economic security in the city. So an important quality of the poverty tracker is that our sample is representative of the city's population, and it contains New Yorkers with all different backgrounds and circumstances. And moreover, we're able to collect detailed information on people's housing circumstances and backgrounds. And we can specifically identify renters, and then within renters, we're able to distinguish between renters that are living in rent-stabilized units, those that are living in public housing, or those that are living in other forms of rental housing.
Sorry, can I just on this slide, can you just clarify kind of exactly how you did your sample stratification? So how did you ensure that your sample is in fact representative of the city's population?
Yeah, so there's like a number of different approaches that we've taken over the years. So I believe our most recent sample is we've done like a random digit dial approach, which is essentially dialing the numbers of a bunch of different New York City area codes. And then we've also done more address-based sampling, where we're looking at essentially a sampling frame of all the addresses in New York City, and then having an approach that is randomly selecting those to receive mailers.
And we then have a detailed weighting procedure and process that makes the sample and our results representative of the population.
And what response rates do you typically get on phone or mail?
That's a good question. I don't have the numbers off the top of my head, but we're happy to provide some of those numbers to you afterwards.
Neither do I. But this data and our ability to kind of focus on specific populations in the city and those living in rent-stabilized housing allows us to look more closely at how these renters are faring economically. And that kind of brings us to our research question for today, which is how are New Yorkers in rent-stabilized apartments faring economically? And so we use the poverty tracker's robust data, both our average annual estimates and the survey's longitudinal structure, to explore some of these core measures of disadvantage that we typically focus and measure among families living in rent-stabilized units. So we'll define these measures throughout the presentation, but as a quick overview, we'll be focusing on poverty, material hardship, health problems, and a few other relevant indicators related to affordability. And we'll be focusing on families living in rent-stabilized units, and again, providing some results from the longitudinal features of the study as well.
Great, and so that kind of brings us to the first outcome we wanted to explore in this data, which is poverty. And of course, this begs the question, how is poverty measured in the poverty tracker in the first place? And so here it's kind of important to distinguish between the official poverty measure, or OPM, and the supplemental poverty measure, or SPM. So poverty has actually been measured by the federal government under the official poverty measure since around the 1960s. This was a measure that was essentially created using the price of a basket of food multiplied by 3 and then adjusted for inflation over the years, and compared to kind of using that as a national threshold for what poverty is. But over the years and over a series of recommendations from the National Academy of Sciences, there have been kind of various critiques that have emerged of the OPM. The first being that it is a national threshold, so it's not accounting for variation in price by geography or cost of living. And the second being that the official poverty measure is measuring poverty specifically based on pre-tax cash income, so it's not accounting for the ways in which the tax system or things like the child tax credit, for example, have a bearing on a family's resources and whether or not they may actually fall into poverty. And so in contrast to the OPM and in kind of response to a lot of these critiques and recommendations over the years, the Census Bureau started releasing poverty measured by what's called the supplemental poverty measure, starting in 2010. And it's kind of directly responding to these different limitations of the OPM. So it's accounting for the value of taxes and non-cash transfers in family resources. And it's also accounting for the differences in the cost of living by geography. And this is particularly important when we're looking at New York City, given that New York City has kind of one of the highest costs of living in the country. And so the SPM is essentially a measure that allows us to better understand the nature of poverty in New York City and also the role that policy plays in bringing families in and out of poverty. And I think one thing also to emphasize is that actually the poverty estimates that you will see actually do have a valuation that accounts for the value of rent stabilization in a family's resources. And so all the numbers that you'll see actually kind of have this baked in value of rent stabilization. And just for context, in 2024, the SPM poverty line for a 2-adult, 2-child family living in rental housing in New York City was $47,190. I think many in the room would agree that this is quite a low number when you're thinking about the cost of living in New York City. And so we are also providing data based on low income status, which we're defining as 200% of the SPM poverty line. So diving into this, the first thing we wanted to look at was the rates of poverty and low income status, both citywide and among families living in rent stabilized housing. And you can see here right away that families living in rent-stabilized housing face both elevated poverty rates as well as higher percentages of being considered low-income status. So in this case, we see that more than 1 in 4, or 27% of families in rent-stabilized housing are in poverty, and more than half, or 62%, are considered low-income. And I think another thing that's important to emphasize here is that over the annual reports that we've produced each year using poverty tracker data, a picture has really begun to emerge that poverty is actually quite widespread among the city, and this is especially true when we're looking specifically at families living in rent-stabilized housing. And so again, when you think about the poverty threshold again for that two-child, two-adult family, which is around that $47,000, and adjusted for family size, essentially what you're seeing here is that more than one in four families in rent-stabilized housing are actually living below that threshold, and over half are living below twice that threshold. And again, one thing to emphasize here is that this is more so looking at rates of poverty and low income status in a given year, but we also know that this doesn't necessarily capture the full picture. And so because the poverty tracker is a longitudinal survey that allows us to follow families from year to year, we're also able to get a better sense of who is ever experiencing poverty across a wide range of years. And for that, I'll hand it back to Anastasia.
Yeah, so as Ryan said, here we're looking at experiences of poverty across 3 years among families living in rent-stabilized housing, so from 2021 to 2023. And we're finding that more than half, or 57% of these families, live below the poverty line in at least 1 year between 2021 to 2023. And this is greater than the citywide average for in the same 3-year period of 42%. So poverty rates for families living in rent-stabilized housing are not only experiencing higher rates of poverty than the average New York City family, but these rates really do increase when we look over a 3-year period.
Sorry, just another quick clarification question. Do you also have the statistic for renters? Because if you compare against the city average, that includes owners, et cetera, right? So I'd be curious what this looks like against market rate renters or public housing residents.
Definitely. We don't have that in this presentation. It's more so just to give a general comparison to the average family in the city, but we're happy to provide those results after the presentation.
Great, yes. And so those are kind of the statistics that we have on poverty, but we know that that is just a singular dimension of well-being. And so another question that we often explore when we're looking at poverty tracker data is this question of material hardship. And so here it's important to understand how we're measuring that in the poverty tracker. And typically we're looking at this across 5 domains to really try to understand and capture families' difficulty in meeting basic needs and routine expenses. So as you can see here from this infographic, we have 5 different measures that we're looking at. So the first is severe food hardship, which is defined as running out of food or often worrying that food would run out without having enough money to buy more. Severe housing hardship, which is defined as having to stay in a shelter or other place not meant for regular housing, or having to move in with others due to cost. Severe bills hardship, which is defined as having utilities cut off due to lack of money. Severe financial hardship, which is defined as often running out of money between paychecks or pay cycles. And medical hardship, which is defined as not being able to see a medical professional due to cost. And here we're defining material hardship as facing at least one of those different forms of hardship. So if you are struggling to afford food often, then you'll be considered a family that is facing material hardship. And it's also important to mention that it's just at least one of those things. So many families may be experiencing multiple hardships. The figures we're about to present, though, are just for those that are facing at least one severe form. And so in this case, we're looking at the incidence of hardship rates among families living in rent-stabilized housing by low income status. And you can see here that when you're actually looking at all families in rent-stabilized housing, more than 1 in 3, or 36%, are facing material hardship in a given year. And you see that these rates are even higher when we look at specifically the low-income population. So for those that are below 200% SPM, or what we're describing as low income in this scenario, it's about 40%, or 4 in 10 families that are facing some form of material hardship. And again, that means that there are 4 in 10 families in rent-stabilized housing that may be struggling to afford food often, having to move housing because of due to costs, having their utilities cut off due to lack of money, and kind of any combination of these different features. So again, I think this is pointing to the fact that, yes, poverty is pretty common. Low income status is, we've seen as like a majority of families in rent-stabilized housing are facing that. And also these kind of have carry-on effects in terms of the actual day-to-day experiences of these families, in terms of what they're able to afford or what they're struggling to afford. And now I'll hand it back to Anastasia for another longitudinal perspective.
Another quick methodology question. How is the question framed in the survey of whether or not a tenant is rent stabilized? I imagine some tenants might not know if they're rent stabilized.
Yeah, that's a good question, and we have kind of a series of different questions that will filter this out. So we have questions specifically on whether or not someone is living in public housing or government housing. We have questions on whether or not someone is living in rent-stabilized housing, and then we also have different categories. For example, when we look at the public housing questions, so whether or not someone is in NYCHA, whether someone is in like a Mitchell-Lama cooperative, and then we also have more specific questions on vouchers as well in terms of, is someone a recipient of a Section 8 voucher or a City FEPS voucher? So essentially we kind of can combine or use these different questions to filter out and define our rent-stabilized tenant population.
So again, turning to kind of multi-year rates of hardship, and Ryan was sharing some kind of single-year averages, but when we're looking over a 3-year period, and in this case 2021 to 2023, we're seeing that around half of New York City families living in rent-stabilized housing have reported experiencing any material hardship in any of these years. And like similar to rates of poverty, rates of material hardship for these families are greater than a 3-year citywide average, which is around a third of the average families in the city.
Great, which brings us to our next outcome. Again, trying to explore these different dimensions of well-being. We also wanted to take a look at health problems and serious psychological distress. And again, it's important to understand how we're measuring that in the poverty tracker. So in this case, when we're looking at health problems, that's defined as having a work-limiting health condition or self-reporting one's health as poor. When we're looking at serious psychological distress, that's defined as having serious psychological distress according to the Kessler-6 scale, which is a set of questions that's actually used by the U.S. National Health Interview Survey to evaluate psychological distress based on symptoms of depression, anxiety, hopelessness, restlessness, kind of a broad range of these different diagnostic criteria. And one thing that's actually also important to mention when we're talking about data related to health problems and serious psychological distress in the poverty tracker is that we're actually only collecting health data on one adult respondent per family. So there's a sense in which some of these numbers might actually be an underestimate of the true prevalence of health problems or serious psychological distress, in the sense that, for example, we're not necessarily capturing if 2 individuals in a family are experiencing health problems, or it could be the case that the respondent is experiencing a health problem and their spouse there may be a case where the respondent is not experiencing a health problem while their spouse is, but because we're only collecting data on the respondent, that their spouse's condition may also be missed from that analysis. So there's a sense in which some of this may be an underestimate, actually. So again, looking at those groups across families in rent-stabilized housing, specifically, again, at that low-income cutoff threshold, you can see here that health problems and serious psychological distress are actually fairly common among families in rent-stabilized housing, with more than 1 in 4, or 28% of families living in rent-stabilized housing facing health problems, and 13% experiencing serious psychological distress in a given year. And again, you see this kind of trend where those that are low income face even higher rates of health problems. You can see here that when you're looking at health problems for families living in rent-stabilized housing that are low income, the rate of 35% is more than twice that of those living in rent-stabilized housing that are not considered low income at 15%. And similarly, you see another elevated rate for serious psychological distress.
Yeah, and importantly, health problems can come and go and might not be restricted to a single year for individuals. And so having a longitudinal approach and looking over a couple of years here is helpful in getting a sense of the bigger picture. So when we turn to 2021 through 2023, we're finding that around half of families in rent-stabilized units struggled with health problems in this period. So that's, again, having self-reported poor health or a work-limiting health condition in at least one of these 3 years. And around 21% experienced serious psychological distress in this period. And again, rates of health problems for New Yorkers in these rent-stabilized units are greater than the 3-year citywide averages at around a third for health problems and 17% for serious psychological distress. And so we've talked a little bit about, some of the core measures of economic disadvantage and well-being that we collect in the poverty, and I wanted to pivot now to discuss affordability a little bit more. So rising costs of living in the city are, I think, on everybody's mind, especially in recent years, and these can pose additional challenges for all New Yorkers. And here at the Poverty Tracker, we collect and ask our respondents and New Yorkers some questions about how they are responding to rising costs in terms of their spending patterns. And these are the results you'll see here, specifically among families living in rent-stabilized units. And I think at a high level, we're finding that over 3 in 4, or 78% of these families, have made some change in their spending patterns, and 2/3 have made multiple changes in their spending patterns to cope with rising prices in the past few years. And these questions were asked in late 2024. And when we're looking more specifically at what kind of ways that these families are changing their spending patterns, you'll see that around half in some of these categories are cutting back on food, utility usage, transportation, and even the amount that they're putting in savings. So in a lot of these cases, these are some essential spending categories. And of course, rising prices in the city affect all New Yorkers. But these results are showing that families living in rent-stabilized units are kind of affected at high rates. And a final indicator that we'd like to turn to is rent burden, which is defined as spending more than 30% of household income on rent. While, of course, we know that rent stabilization plays a big role in keeping housing costs low for families that live in these units, despite rent stabilization, rent burden is highly common among families that are living in these units. So here we break out among rent-stabilized families by their poverty status and where they sit in relation to the poverty line, and look at rates of rent burden. And we know from earlier in the presentation, as Ryan shared, upwards of 60% of rent-stabilized families are living in below 200% of the poverty line. So that's the first 2 rows. And among those in poverty, at least around 3/4 are experiencing rent burden. And when we look at those living just above the poverty line, around 40% are experiencing rent burden or spending, upwards of 1/3 of their household income on rent. So to conclude our findings here today, the Poverty Tracker is a study that's pretty well positioned to look at specific populations in the city and zoom in. In this case, we've zoomed in on the families living in rent-stabilized units and have provided an analysis of their economic circumstances. And our data shows that families living in these units experience high rates of economic disadvantage, including poverty, material hardship, and health problems. And when we kind of zoom out a little bit and look over multiple years, we find that these rates of economic disadvantage are even higher, where roughly half of these families are experiencing around one of these disadvantages. Rent stabilization, of course, still provides a benefit to these families and is baked into our poverty measures despite their economic circumstances. But amid rising costs in the city, which I assume are on a lot of our minds, families in rent-stabilized units really continue to struggle with affordability, including rent burden.
Great, yeah, thank you so much. And we're happy to answer any questions, and we can also obviously send additional follow-up analyses for other questions too.
Great, thank you. Anybody have questions they want to have? I was curious, your statement, Anastasia, and you said at the beginning how you bake in rent stabilization into this as a measure of poverty, how that works.
Yeah, so it's kind of so basically a lot of when you look at housing vouchers or things like that, there's essentially a process where you're looking at the gap between what someone is reporting as their rent and what the fair market rent is for their family size. Sure. And so in the case of rent stabilization, we are following a similar methodological approach where if someone's reporting that they're living in a rent stabilized unit, we're looking at that gap between what they're paying in rent and what their expected rent might be under like a fair market rent situation, and essentially adding that gap to their resources as an in-kind transfer.
So, just to, so if let's say median rents are $1,500, and I don't know, the median market rents in the city for non-rent stabilized units is what, over 4,000? I forget the numbers. You take that amount, the difference, and then that becomes, so to speak, income?
We are adding that, but we're actually also capping it based on kind of
at some number, yeah.
Shelter and utilities portion of what the poverty threshold is. So there wouldn't be a case where there's kind of like a huge...
No, it's not going to be this big. It'll be...
Yes, exactly.
So there is, but so even after that, that's how you get to the poverty measures.
Yes,
so you take that into account. There's not a way to really easily compare people of the same income in rent-stabilized housing or not in rent-stabilized housing. It's a hard comparison because you bake in that comparison. I see. Interesting. And the same, I assume, for like public housing and other forms of subsidized housing? Got it. So it's really a form of income transfer, so to speak. Got it. Interesting. Okay, thank you.
Do you take into account in your data the number of tenants that receive public subsidy, whether it's city FEPS, HRA,
Yes.
to actually pay the rent on their behalf?
Yes, so we actually do differentiate between that when we're actually asking these questions in our survey. So it's kind of a series of different questions where the first may be asking about whether or not someone's living in a rent-subsidized or stabilized apartment. And then there's additional questions on if you're receiving a subsidy or having the government pay in some way for your rent. Is that like a city FEPS voucher? Is it a Section 8 voucher? And then we also have questions on sort of like public housing type, so whether or not someone's living in NYCHA housing or a Mitchell-Lama cooperative, for example. Basically, we're able to use answers to all those questions to kind of derive at more specific definitions of whether or not someone's living in rent-stabilized housing.
Okay, and then based on that, do you have the backup? 'Cause I didn't see anything in here that could show how those questions were answered with respect to those subsidies?
Yeah, we can provide some follow-up information on the breakdown between, the overlap between people reporting rent stabilization and subsidy receipt and et cetera. But we don't have it for this presentation.
Thank you.
Alex?
Thank you. Would it be possible to compare some of these indicators of hardship, for example, by different categories of housing? So rent stabilization, public housing, Mitchell-Lama, unsubsidized housing, just to see to what degree the rent stabilized housing stands out. And
Yeah.
perhaps for people who are in poverty, based on your measure, not.
Mm-hmm. Absolutely.
Yeah, we can definitely follow up with that.
Okay.
So just to follow up. So if they do indicate, for example, that they are receiving a Section 8, do they give you, so they're giving you the rent level, and then are you factoring in the amount they're getting from that voucher or from FEPS when you calculate the rent burden?
Yes, because we're essentially, actually, I may need to get back to you on that one, but as far as I understand, we're following a similar methodological approach in terms of valuing that subsidy by looking at that like fair market rent gap and then capping it based on the poverty threshold. So I believe we're including that in resources, but let me get back to you on that for the specifics.
I just want to ask one last one. I thought most of the distress responses made sense, but the food one surprised me because of the excess shelter cost deduction in food stamps and SNAP. That for basically every dollar above 30% of income, you get an extra 30 cents in SNAP benefits. And so, is it your sense that people are not people are not enrolled in SNAP, or it's not? I'm just curious. I found most of it intuitive, but the food one shocked me because SNAP, food is the one vector that we actually increase with respect to rising rental costs in terms of income supports.
Yeah, that's a good question.
Yeah, I think. Are you talking about the affordability suite of?
Yeah, like
options?
when you're basically in response to rising rental costs, what do you do? And some people said cut back on food, but I'm like, but your income transfer specifically restricted to food rises when you're more rent burdened, and so I was surprised to see that one. Yeah.
Yeah, I think it's a really interesting point, and if helpful, we can dig into some of our information on SNAP receipt also among these rent-stabilized families, because we're not sure what proportion are receiving and stuff like that. But I think that's definitely part of it.
Yeah, I think one thing I'd also add as well is that we actually released a report on food insecurity a couple months ago. Actually, I guess in November, so the end of last year. And what we found in that report was that there's like an increasing percentage of New Yorkers that are utilizing food pantries compared to previous years, and that also that the percentage of those using food pantries that were also simultaneously using SNAP was lower than in previous years. That could be explained by a number of things. It could be explained by a widening pool of people that are accessing food pantries, so maybe a new group that is ineligible for SNAP is now using it, but we are seeing some different trends in terms of SNAP usage, and that could be related to like ineligibility. It could be related to stigma or these other kinds of things. But we have noticed some changes in SNAP usage and like increases in food pantry usage and things like that as well.
You know what's the maximum income to qualify for SNAP in New York City?
There's kind of a
For
few
a family
different.
of four, right? That's what you were using here.
Sorry.
For a household of four, what would be the maximum income to qualify for SNAP? I think it's
There's a
pretty
kind
low.
of like two different income requirements for SNAP. One is the 130% of household income of the federal poverty line for your household income, and then SNAP. When assessing your eligibility, they kind of come to a value of like a net income that accounts for shelter and medical and childcare deductions and things like that. And your net income, which is not calculated here in this presentation, but that has to be below 100% of the federal poverty line.
And what is the 100% for a household of four?
I don't have the exact number on me because the federal poverty line estimates are different than those of the supplemental poverty line because we're accounting for geographic adjustments and things like that. But happy to circle back with that number for you.
It's way below this number.
Definitely.
So most people in this sample don't qualify.
Yeah, so
even though they're rent burdened.
Exactly. Yeah. So the federal poverty level would be lower than that 47,000 number we published, and it would definitely be lower than that 200% threshold or low income threshold we were defining as well. So it could also be the case that increasing number of people are struggling with costs and ineligible for SNAP, and so that may also explain some of that change in food behavior.
Okay, well, thank you very much for your testimony. Really, very much appreciate it. Thank you.
Thank you all.
Great. Thank you so much.
Okay, I think we're on target. And up to our final speaker, Tony Titano. Tony, come on up.
Andrew.
Maybe down by Christina. Hi, Christina. Welcome. Didn't see you come in. Thank you. Here, I did the same, so I'll give you mine. Welcome.
Thank you.
Nice to see you. I just now want to introduce Anthony or Tony.
Same thing.
Titano, the Acting Deputy Commissioner for Rent Administration at the New York State Housing, Community, and Community Renewal. And I think with your colleague, you want to?
Yes.
April Gray Huertas. I am Deputy Bureau Chief in the Property Management Group.
Great. Welcome, April. Welcome, Tony.
Good afternoon. I'm good. I'm good. You good?
Yeah, I'm good.
So, good afternoon. Like you said, my name is Anthony Titano, also Tony Titano. I was recently appointed Acting Deputy Commissioner to the New York State Home and Community Renewals Office of the Rent Administration, also known as ORA. While I may be new to this position, I have served in various positions at ORA for over 36 years. On behalf of State Housing Commissioner Lucian Visnauskas and our hardworking staff at ORA, let me extend our sincere thanks to your continued willingness to serve the people of New York City. Before I begin, let me introduce you to April Gray Huertas, Deputy Bureau Chief of the Property Management Bureau, and Mike Barrios, who I think you all know, Executive Assistant to the Deputy Commissioner, who works closely year after year with the Rent Guideline Board staff and is responsible for putting our reports together.
Just a comment there, we love Michael. So.
Everyone's Michael. Chairman Apple and the members of the board, I thank each of you for the opportunity to provide you with an update on the recent activities at ORA and for allowing us to be part of the process. As you know, ORA enforces the state's rent regulation laws throughout New York State. We strive to ensure that both tenants and owners know what their rights and responsibilities are under the laws of rent regulation, allowing for tenants and owners to contact us if the need arises. Since appearing before the board last year, ORA has continued to improve the ease and efficiency of our service platforms. This includes multi-language translation assistance, online application filings, quick access to individual case and rent records, and more transparent reporting mechanisms. Some of the highlights in the last year is that we've attended community forums to provide information to both tenants and owners regarding our policies and procedures. We provided thousands of rental histories to tenants each month. We reduced our case processing timelines for overcharge cases, service reduction cases, and major capital improvement cases. We've worked closely with the New York City Department of Housing Preservation and Development, the Department of Buildings, the Department of Finance, the Mayor's Office of Special Enforcement, and the Housing Authority's Office of Section 8. We've continued to improve our public transparency, which includes providing monthly case processing data, key matrix, appeal decisions, and our individual apartment improvement report on our website now. We also created the late registration unit that resulted in an additional 120,000 units being registered for 2024. And lastly, we introduced a new rent registration data dashboard available on our ORA website. This dashboard provides users with a snapshot of the current submitted status of rent-regulated apartments across the state for the past 5 years. Looking ahead, I want to reassure New Yorkers and the members of the Rent Guidelines Board that ORA will continue to provide our day-to-day services and operations. Thanks to our dedicated employees and our relationships with housing stakeholders, ORA will continue to be a strong partner that you can rely on. On behalf of Commissioner Zarnaskis and our entire team at HCR, I wish you success in your deliberations and offer you ORA's continued support and cooperation. Thank you. Glad to take any questions you may have. Of course, I forgot my glasses at home, so, you know.
I'm gonna start this one. One of the more challenging issues we're sort of wrestling with in this complex process is the impact of some of the changes in policy over the last several years on these buildings. There's been a lot of conversation about IAIs and MCIs. I know there were some adjustments in the most recent, so probably don't have any data. But, and then we hear often about units that are now still remaining vacant. Do you have any way or any measures or any sort of data on that particular topic?
Well, we do. We found that, like you said, we recently adjusted some of the individual apartment improvements, how you can apply. And there were 2 criteria they had if you wanted to have at least a $50,000 individual apartment improvement.
Right.
And one of the criteria was being registered vacant for 3 years in a row for 22, 23, and 24.
Bless you.
And the second criteria was if an apartment that was occupied for 25 years or more then became vacant, that would also be eligible. What I can tell you, we received about 200 or so applications that say they're eligible. And the overwhelming majority is for the 25-year occupancy that vacated, not the 3-year vacate in a row.
Mm-hmm.
Very few for that. So
when you say you received 200 applications, that's for IAIs?
Yes, that's one.
200 out of a million. Out of
the 50,000 individual apartment improvements where they have to certify eligibility first.
Right.
There's one for up to 30,000 if they don't have to certify, but the 50,000 was for the vacancies, you know?
Sure.
And the 3-year vacancy ones is really the majority. It's not, you don't see many of those coming in. It's all the overwhelming 25-year occupancy.
So do you have, it may be in here, I haven't gone through all the data, I'm sorry, IAI and MCI data, number of, not even dollars, but just number of units filed for?
Well, I can tell
over a period of time, so we could, and that trend may, see, the trouble is, it won't answer the real question, which is how many units weren't applied for that are indeed vacant. So it would have to be a triangulation, I think, because no one seems to have that data.
Yeah, I mean, with MCIs, the apartment could be vacant or occupied, right? It's for the
Correct.
building one.
So it won't necessarily.
Right. Now, what I can say about major capital improvements, MCIs, is that since the Housing Standard Protection Act of 2019, clearly we used to average about 1,000 applications coming in a year, okay? And since then, it's about 300,
Right.
You know, now.
Sure.
Many reasons. Housing, you know, it could be because of the law, yes. COVID, yes. Inflation, yes. Many factors that come
Right,
in.
exactly.
You know, but that's the trend that we're seeing. So those are down. We know the individual apartment improvements, because they have to report it to us, you know, is down. You know, what we would have seen previous, underreported, it wasn't reported to us, but we know just from a fact that it's not as high as you would think.
So, let me just jump in on question number 17.
Right.
It's not, the pages aren't numbered here. We printed out the responses that, to the questions that the board posed, and thank you for answering those. But I guess to your point, there were 590 MCI applications filed in 2020. The 4 consecutive years after that was 323, 276, 305, and then this year 343.
Yeah, 300 or so a year.
Yeah. So is it possible to get the units that impact rather than just the applications, or is that, would that be more helpful to have units?
Building size? We'll try and get that too, yes.
Okay.
We'll get the building size for each of the applications, right?
Yeah, there is no measure, I don't believe, of what I'm asking, which is how many units today are vacant and not being re-rented. That's impossible to know.
You know, as of April 1st, how many registered as, you know?
Exactly. Whether
that's
they're
what we know.
occupied or not,
Right.
you know the registration number. We know certain data about those units, but there's no way really to know. And this sort of, out there is this sort of whole, I won't call it a myth, but I will call it an unknowable.
Yeah, like I said, I think, except for the COVID year that we had, that really threw
Yeah.
those numbers off.
Threw everything off.
We're at the
2021
normal
just
level.
threw out the
Right,
window.
We're at the normal level, we would say, yes.
Right. Okay, thank you. One, Alex, or other.
Tony, can you repeat what you said? So prior to 2019, there were 1,000 applications, was it a year for combined MCI, AEI,
No,
or
that was just for,
Those-
you know, before 2019, IIs were not really reported to us, before HESPA, but before that, we just know for MCI,
MCIs only.
applications were about 1,000 a year.
And now it's about 300.
About three, yeah.
350.
350, you know, it will vary, sometimes went below 300, but about 300.
Okay.
I was going to say, I think, do you find it surprising that, I mean, it seems like with buildings income suppressed since 2019, that MCIs, shouldn't owners be essentially desperate for any applicable means to obtain?
Well, you know, the housing HESPA, as we call it, right, did change the landscape. I mean, they changed the amortization schedule, okay? Also, it's no longer retroactive when they filed, it's in the future. Violations that now, not just immediately hazardous, but also hazardous. And one of the issues I know owners have said is that, you know, they could, anytime they get a violation, to get it cleared from the HPD or DOB, they come and do a line of sight inspection and gets another violation, which keeps on delaying the process. Okay? But also, one of the main factors was when it was lowered from 6% to 2%. The return on investment takes a lot longer to get your money back. Okay, like I said,
And temporary.
and it's temporary. I mean, it's 30 years, but it is temporary increase. You know, there are many factors that go into it. Like I said, I wouldn't doubt, you know, COVID does play a role. It's like a perfect storm that happened.
Right.
That's but COVID, inflation, so you do have some issues there, yes.
And then on, was there a J51 interaction? Were MCIs J50, in other words, were you able to use J51 and MCIs together? Okay. So like it's also on the tax front, the net tax return on the application is down as well?
If the owner applied for a J51, it made the entire building stabilized. So again, if they had a mixture of non-regulated and regulated, they may not want to get the J51 to restabilize all those apartments.
Thank you.
Can I ask a question on preferential rents? You have the number of units that have preferential rents, which is like 300,000. So 30% or so of all rent stabilized units have preferential rents. You then have registration year average rent discount. you have average and median. So the median preferential rent of those 300,000 is $480. So meaning the actual registered rent is $480 above what they're actually being charged. And that stayed pretty constant over time, right? $500, give or take, even as rents changes. So they're, they're marking up the actual rent, the registered rent, but they're not necessarily marking up
Right. As a matter of fact,
because rent being charged.
We've gotten a lot more registrations for 2024.
Right.
Because of that. The
Yeah,
average.
you did have a huge number, so
Yes,
congratulations to you
yes.
on that. That's a lot of work.
There's a lot of work by staff that really
Yeah.
made this happen.
Yeah.
And, we saw that the average did not change that much from the year previous,
I see.
So
So
a lot
even
more
though more
units-
units are registered,
Right.
they're still getting registered at preferential rents at the same rates as previous. So that's sort of static.
Yes.
Interesting.
Well, with our adjustment.
Right.
You do
No,
both the
understood.
legal.
Both
and
go
the
up,
rent,
both go up by the
go
same amount. No, I
right,
get
right.
it, I get it.
Hi.
A question about automation, and it seems there's a new platform for FOIL. Do you know about that?
Yes. There is a new platform for HCR on FOIL,
Yeah,
okay? But the ORA is still a little bit outside of that FOIL thing.
I see.
It's separate to ORA.
So the platform would enable owners to request overcharge complaints, or do you know exactly what the new platform, I guess I'm getting at, even on the $50,000 IAI, or just in general, as landlords sort of interface with the agency, everything's still by paper. Most everything. During COVID, we could serve by email, but since COVID, responding to complaints or putting in a response to, say, a building-wide decrease, all of this is like paper-driven, and there's no sort of system to see when an owner answers something and then a tenant answers something, and I just wondered if that's something the agency is considering. I'm encouraged by the new launched FOIL platform, but if there's some other automation that's in the works.
Yes, we have we call a legacy database that's over 40 years old now. And we are looking to replace it and have all the bells and whistles of, filing online, answering online, and then having tenants and owners go to the website and actually review their records without even interaction from us.
Yeah.
But you can imagine having years of records and getting the right, person online. We're right now in the RFP process of, trying to modernize the whole system.
Got it.
And it's tons of data that we need to bring over to a new system.
Yep.
Yes, that is the actual goal to have.
I will say the housing court managed to do it during COVID, and now all of our filings where they didn't used to be, but now they are electronic filing. It's made a world of difference, just
Yes.
a lot
We do have
more
some online-
transparency.
We do have some online filing for tenant complaint of decreased services, and owner can file a restoration application online.
Yep.
I know you can file this individual apartment improvement to notify us online. There are some things we do have, but we always want to do more.
Thanks.
Genesis?
Yeah, I see that it seems like there has been an increase on the average, on the number of overcharge complaint cases, right?
Yes.
Will you say that it's been increased?
It's been increased, yes. Go ahead.
Would you say there's a correlation between those units and the units where the landlord applied for IAIs?
There is no correlation that we can see like that.
I'm assuming that data has not been matched yet.
It hasn't been passed,
Yeah,
right.
so is it possible to do that at some point, to see?
I think we could probably do that to see how many have filed an IAI and a subsequent overcharge complaint did come in.
Yeah, I'm also assuming there's no data to see, well, I wonder what is the number of retroactive registrations?
Well, I can say this, that when we started the late registration project for 2024, part of our thing was also to register for prior years, going back to 2019. So on our registration dashboard, we will now show other, 2019, just short of 1 million units, and every other year going up over 1 million units. Statewide, that is statewide. But most of them are in New York City. So that has been where we used to have, at one point, 850,000, maybe 925,000, and you'd see that they come in late. Now we have over 1 million for all those years going back. So that's been a tremendous look back for us, yes.
What I noticed is that when I look at the data by ANHD, they have a portal, right? You see that there's a great number of apartments with no registration. They said there's 0 rent-stabilized apartments in 2021. So now 2024, they have, I don't know, 10 units. So do they regulate the units? I don't know where. But there's no, the portal doesn't show that they did any retroactive registration. It's just the apartments completely disappeared and now they're appearing again. So I'm assuming that there should be some correlation between other people filing for overcharges because they were living in those apartments.
You know, I don't know about that report, but I can say we've seen them re-regulate. You know, that. Obviously, they have registered them. You know, just because it wasn't registered, they weren't regulated.
Yeah, well, the tenants don't know.
Right.
So you get to apply for an
And
III.
that's why, you know, one of the things we say, why would an overcharge increase like that? Even services is increased, right? You know, as you have more registration out there for an extra 120,000 units, people will get notified, register with us and notify the tenants, 2-part registration. Well, that's part of what, hey, I could go complain here and then, you know, see what happens. Look at your rent history and then see, you know, maybe you're being overcharged.
Yeah. Only if people knew that they could do that.
I wish more people would.
Yeah. I would love to see a correlation, side to side.
We'll try.
Great. Very good. Tony, thank you very much.
Thank you for having us.
Thank you.
I wish you luck. I know it's a very difficult process that you have to do.
Oh, you have a lot on your plate too, I know.
Thank you.
Thank you. Thank you.
Thanks.
Let me see if there's any other business or issues the board. With that, I ask for a motion to adjourn.
Can I interject?
Sorry,
a
we
second?
do have something more.
So I have gotten menus.
Oh.
If there are other menus out there for next week, please get them to me before. Yeah.
Okay.
And,
Menus.
and please note that there was the public hearing dates and schedules were sent around yesterday.
Right.
Please take a look, make sure you are available those
Right.
dates.
And we're still working on a date.
We're still
for the
working on a date
final.
for the final.
It's been difficult to find a venue. So we'll have that hopefully next week, right? Yes.
Yes.
Okay, with
Next
that,
meeting.
a motion to adjourn? Second?
Second.
We're adjourned. Thank you all.